Santander, some fairly positive stories in general being told by the banking sector this morning. We'll also look for any read across from higher yields. We have had that as part of the narrative over the last 24 hours, certainly the US 10-year a little bit higher. So all of that in focus this morning. Let's get to our first markets conversation of this hour then. European equity markets, as I say, opening to the upside. Bond yields are rising again as markets look ahead to updates on government and central bank stimulus. That's as President Biden is set to address Congress and the Fed is giving its policy statement later today. Investors will be looking out for Fed Chair Powell's views on inflation and for any signs of the central bank pulling back on asset purchases as the economy gathers strength. Let's bring into the conversation Yuko Takano, Newton Investment Management Global Equities Portfolio Manager, who joins us this morning. Yuko, very good to speak to you here on Bloomberg TV. Let me ask you about the rising yield environment, and then we'll come to some of the earnings stories this morning. Yields on the US 10-year, 1.63% right now. We did see some upward movement in yields, some selling of bonds in yesterday's session. Is this a sign of something to come, something that's going to threaten equities, do you think, a higher yield environment?
I think definitely we saw that kind of scare in Q1 of this year already. And then it kind of was a bit subdued over the past month or so. So I can definitely expect an environment where investors do have incorporated the fact that, yields are going to continue to go up with the, stronger economy post-COVID recovery. So in that sense, yes, it's definitely something that we're concerned about. It impacts all of the discount rates on the equities that we own in our portfolios. So definitely something to think about. Having said that, I am not really sure how much higher yields can go up from this point onwards. So I would say much of that is already baked into the stock market.
Yeah, that's interesting because some people suggest to us, if you think yields are going to go higher, if you think we're going to see more of that reflation trade that we talked about earlier this year, Yuko, then you want to consider owning bank stocks. But I see from your notes that you're underweight bank stocks. Is that because you don't see the reflation trade playing out much further from here?
So we've always been structurally underweight banks, but we have increased our bank exposures slightly over the past couple of months due to this, possibility of a reflation trade. I do think in the long run that there are other sectors that are or continue to be more attractive. We're a very highly concentrated portfolio and we're bottoms up stock pickers. So in that sense, I would say that we don't feel uncomfortable not being super bullish on the banks.
Okay, and as bottom-up stock pickers, Yuko, you look at the earnings season, you comb through the earnings reports from the companies that you own, that you have in your global equities portfolios. What has impressed you? What has stood out as a surprise to the upside then from some of the companies that you follow?
I would say, like you saw in the earnings announcements yesterday, I think tech continues to be an area of resilience. And that, partially has to do with the fact that they are very resilient businesses in nature and they're very asset light and IP heavy. I also think that, they will continue to benefit as, economic activity overall continues to surge post-COVID. And you can see that in the Alphabet earnings from yesterday.
Yeah, we'll certainly dig further into your thoughts on tech in just a moment, Yuko. Another sector that's front and center these days is anything to do with commodities. And I want to think about, one of the themes that you like to invest around is EVs, electric vehicles, and copper and other commodities needed in production of electric vehicles have been doing good business of late. Yuko, do you see that continuing? Do you see that commodities drive higher as something that you want to follow?
That's a really good question. So in our portfolios, we don't invest directly in commodities and we don't really invest much, to be honest, in, the mining sector. We think that the EV angle can be played through a lot of the parts manufacturers and battery manufacturers because they do play directly onto the theme. And we do feel like that's a more comfortable way for us to invest.
Yuko, thanks very much. Stay with us. Yuko Takano, Newton Investment Management Global Equities Portfolio Manager. She's going to stay with us as we bring you our next conversation with another company CFO. Then we'll get more from Yuko a little bit later in the program. Coming up here on the European Market Open, we'll focus in on pharma. We'll talk to the CFO of Sanofi about the drug maker's earnings and its latest efforts to develop a coronavirus vaccine. They're still trying to develop that. We'll ask, what is the expectation from that project? This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the European Market Open. Just 9 minutes into our session this Wednesday morning, European equity markets fairly flat actually on the stocks, Europe as a whole, but we do see some moves to the upside from some of the larger equity markets on your screen. Now let's turn to the pharmaceuticals industry. Sanofi's first quarter earnings beat estimates, boosted by demand for its blockbuster treatment for eczema. The French drug maker's COVID vaccine development has lagged some of its peers. It expects results from the phase 2 study from one candidate next month. We're joined now by the CFO of Sanofi, Jean-Baptiste Chatillon. Jean-Baptiste, really nice to speak to you. Thanks for joining us here on Bloomberg TV. Let me start by talking about the earnings, and then we'll move on to talk about COVID a little. So the EPS numbers coming in well ahead of expectations, but you've confirmed your outlook. Is there a sense that there's risk to the upside for Sanofi later in the year?
You're right. We have a great quarter, and we enjoy something which is new in Sanofi, which is a sustainable growth. After 2019, 7.2% upside on the EPS, 9.2 in 2020. Now we are delivering 15% on this first quarter, 9.8 without one-off. It's a great trend. It's a great trend in Sanofi. And it's also a great opportunity this quarter to present our maturing pipeline with priority asset, RSV, which has shown in phase 3 that it was meeting its endpoints. So two great news for Sanofi and for patients in this first quarter. Growth on pipeline, which is going in the right direction with huge unmet need, which is RSV.
Let me ask you about pipeline development, Jean-Baptiste, because some other pharmaceutical companies have talked about delays in clinical trials and therefore in pipeline development because of COVID-19, because of health systems, entire health systems being entirely distracted over the past year by dealing with something else. Is this something that's going to weigh on pipeline development in the future?
It might be for the industry, but honestly, in Sanofi, great job from all the teams all over the world. And we are holding our pipeline development in a very good shape. And by the way, RSV is not late, is ahead of time. We are effectively beating the expectations on the development of this new drug. So good news from that front. The teams are improving their game in terms of digital, and they are really delivering incredibly. And the pipeline is there and will not be late.
Jean-Baptiste, you're working on two COVID vaccine candidates at the moment. They're in clinical trials. You've given an update today on the timing. You're also helping in the production efforts behind, I think, 3 of the vaccines that are currently on the market and approved in various locations. Why do we need another vaccine? Would it be better for your business or indeed for humanity to focus on higher levels of production of the existing vaccines that are already approved?
That's a great point. I think Sanofi is the only pharma actor who is going to contribute to improve the worldwide capacity for the 3 leading vaccines which are available right now, with BioNTech, with Pfizer, and with Moderna. We just announced it yesterday. So we are strongly committed to fight this pandemic in Sanofi. And of course, this will not change the course of our 2 internal candidates, because our teams are working extra hours. They are pushing the walls to make this capacity available. But at the same time, when we see how the pandemic is unfolding in terms of variants, in terms of maybe being there for several years, society, I mean, the US BARDA is really asking us to go on working on our 2 candidates. That's what we're doing. And we think they could be very useful in the years to come.
Yes. Is the work that you're doing on these COVID vaccines, though, is it focused on the original version or the original variant of COVID-19 that emerged in China, or will it stand up to the various variants? Because others in the sector, of course, are moving their products on to try and tackle some of the newly emerging variants. How will your vaccine take on those?
Yeah, so the current development are, of course, on the first strain, but we have in the preclinic, we are, of course, putting on the bench and starting to work in our labs preclinically on the new variants. So, of course, it will be part of the developments we will pursue.
And back to the other products that you make, Jean-Baptiste, at Sanofi. Some critics might question whether your business is too reliant on one particular medicine, on Dupixent. Is that a criticism you hear from shareholders? Is this something you're thinking about?
Yeah, that's an interesting point, because Dupixent is effectively a miracle drug, and with a high safety profile, high efficacy profile. But, you know, it's just the beginning of the story of this incredible drug, which will reach, we think, above 10 billion peak sales. And that's just the very beginning of the story. It's not just one drug. It's a drug which addresses multiple diseases, like you mentioned asthma earlier on, but of course it's atopic dermatitis, nasal polyposis, and we are developing it in many other diseases where unmet needs are very strong, for instance, in COPD. So it's just the beginning for Dupixent. And we're not worried, and well, not questioned yet, as I said, it's very early in the cycle, but also because in our pipeline, currently in our priority assets, we have many blockbuster potential. I mentioned RSV, which is a huge unmet need and one of the first reasons for hospitalization of children. But we also have many other assets in oncology, like our third, or I could mention in MS, tolebrutinib, which is being developed in multiple phase 3 by Sanofi. So the fact that in Play to Win, the strategy initiated by our CEO, Paul Hudson, we are really focusing on very specific areas, but only with blockbuster potential.
Okay, Jean-Baptiste, thanks very much for your time. Jean-Baptiste Chatillon, the CFO of Sanofi, giving us an update on the earnings this morning, but also on the COVID fight, of course. Let me just bring you some other news lines that are just crossing the Bloomberg. The EU Parliament has backed the UK trade deal, concluding the Brexit process. So these headlines just crossing in the last few minutes or so. This, of course, means that the EU Parliament has voted in favour of the arrangements that essentially came in on January the 1st. So they've been in place for a while. The EU Parliament took some time to consider the details because they were, of course, reached. The agreement was reached very hurriedly, if you like, or quickly before the deadline around the December-January period, or just before January the 1st. There are still ongoing conversations about the Northern Ireland Protocol, but broadly, in the main, the EU Parliament has backed the UK trade deal, concluding the Brexit process 5 years, 6 years after that Brexit vote. Let's take a look at some of the stocks that are on the move then this morning. For that, here's Bloomberg's Danny Berger.
Anna, I just want to concentrate on one theme that really seems to have captured the market, and that's bank earnings. Now, something really interesting is going on here because we've seen with earnings that beats haven't done that much to move the dial in terms of gains really across the equity market, but it is doing that for banks, so perhaps expectations were lower for the sector. So Lloyd's, one of the best performers, seeing a beat on their earnings, also talking about resuming dividends, so that's surely a good sign. Over in Germany, Deutsche Bank, an absolutely blockbuster earnings. They reported FIC trading that was 34% higher. That compares to 17% on Wall Street. So that's one of the biggest gainers as well, up 6%. And as my next stock, I also brought up Commerce Bank. It doesn't have earnings, but it's rising in sympathy with Deutsche Bank and really the other bank earnings. If you look at the Stock 600 Bank Index, every single stock, it has 40 members, is moving higher, save for 3. So BBVA, Barclays, NatWest, whether they're UK specific or more international, they're all seeming to get a bid today with these solid earnings. Now, if banks is one theme, the other theme in the markets today, but perhaps more macro, is what's going on with commodities. Finally, they're getting a break from all of those gains. So up here, I have iron ore, I have wheat, I have copper as well. We're looking at wheat, for example, falling from an 8-year high, copper falling from its highest since 2011. Now, Goldman Sachs thinks that these commodity gains can continue, but at least for today, perhaps a little bit of a breather from those inflationary scares with commodity prices moving higher, Anna.
Yeah, interesting stuff, Danny. Yeah, basic resources stocks fairly flat today, taking a pause from what we've seen has been a really strong move to the upside in commodities prices. Thanks to Danny for that. Bank stocks, the biggest gaining sector across Europe, up by just over 1% for the sector as a whole this morning. Coming up on the program, Google parents Alphabet's first quarter revenue has smashed estimates. We'll discuss the US tech sector next. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Welcome back to the European Market Open, 21 minutes into our European trading session, and stocks fairly flat at the aggregate level. You see some movements to the upside in some of Europe's largest markets, though. The banking sector certainly doing very well this morning, as we were hearing from Danny in the last part of the program. Let's turn to another sector, and that is technology and tech earnings. Google has seen a surge in ad sales. That's as businesses look to capitalize on the economy reopening. Google's parent company, Alphabet, reported earnings that topped estimates. The firm also unveiled a $50 billion buyback. The shares rose in late trading. We're joined still by Yuko Takano, Newton Investment Management Global Equities Portfolio Manager. Yuko, thank you very much for joining us once again. Let me ask you about your thoughts on technology. Regulatory threat to the technology sector seems to be something that's often on people's minds. Is that something that puts you off?
Yes and no. So I think that for the big tech names, each case is different in terms of what types of regulatory implications there are. So in the short term, obviously, as news comes out, this is a big concern for us, and we continue to monitor the situation quite closely. Having said that, I think that there's antitrust laws there for a reason. I think that anything that kind of promotes innovation, promotes more competition, is great for, firstly for the overall economy, but also for the companies themselves. And you've seen time and time again in the past where history repeats itself, and either companies are broken up or are forced to spin off some of their entities, and that enables them to actually focus even more on their capital allocation, which is actually better in the long run for these companies. So it's not just all bad news. I think that there would be some positives that come out of this as well.
It's interesting to see in the specifics around Google parent Alphabet and the earnings story there, or where the boost came from in the first quarter. There's a lot of reference to advertisers advertising for travel and leisure and things that we haven't been able to do.
Yes.
And I suppose that's just a nice reminder, isn't it, Yuko, that we shouldn't think of the tech sector as monolithic. We shouldn't think of it as all, it's not all Amazon. It isn't all sending stuff to your home that you can't go out and get. There are going to be some tech businesses that will manage to navigate lockdown and also reopening.
I mean, exactly like you say, I think that's a really, really good point. I think that, the reason why some of these companies are very attractive is because, A, they're very highly resilient businesses, but B, also because they're very asset light and IP heavy. That for us as investors means that it's got really high return on invested capital, which is all very positive. But at the same time, it enables the companies to be very nimble and very cash rich. And I think all of these factors combined makes them very strong businesses.
We spoke to a pharmaceuticals business in between our conversations, or I spoke to a pharmaceuticals business in between our conversations, Yuko, this morning. And that makes me think of some of the long-term thinking you've been doing around healthcare and around life longevity. How investable is this as a theme? Where are you seeing money going that looks promising with investment returns in terms of fighting some of the diseases away from COVID-19 that we need to be fighting over the next decades?
Yes. So we have a future of life fund that invests in the longevity theme. And, we're very, very positive about the sector and, about the theme. So longevity is not just about the healthcare sector. Obviously, there's a lot of innovation going on in terms of, pharmaceutical innovation. There's like Alzheimer's is one really big area. Diabetes is another one. So those are very obvious places that we can invest in. But at the same time, there's other elements within longevity that we find very attractive. For example, the prevention side of things. And prevention can include, pharmaceutical interventions, but it also has a lot to do with lifestyle and managing your diet. So we're definitely interested in the nutrition side of things. The other thing that we're really focused on when it comes to longevity is the area that, the elderly like to spend in. So things like home improvement or, hopefully travel when travel comes back.
Yeah. Yes, when travel does come back. And I really wanted to ask you about food innovation, Yuko, but no time today. Another time. Thank you so much for joining us. Yuko Takano, Newton Investment Management Global Equities Portfolio Manager. Yuko will be continuing her conversation with us on Bloomberg Radio at 9 a.m. UK time. Coming up, we speak to the CEO of WPP. Mark Reed joins us to talk about the organic sales numbers that came in better than anticipated for this business. Fast-changing environment, though. We'll talk about that. This is Bloomberg.
One of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. Half an hour into our European trading day here in Europe. And this is the picture for you. We have the Stocks Europe 600 fairly flat overall. And that doesn't seem to make sense when you look at what's going on the larger markets. But the AEX is actually in negative territory, weighed down by the payments business, Adyen, ASML in the tech space, also to the downside in the Netherlands. And so that's partly what's driving that Stocks 600 move to the downside. So that's the picture in terms of those overall markets. Let's get to the GRI. You can see from the sector breakdown that we do have banks to the upside. Danny Berger was taking us through some of the individual corporate reports reports we've had from the likes of Deutsche Bank this morning that have helped to lift that sector, and other names not reporting but rising in sympathy. So the banking sector moves to the upside today. To the downside, travel and leisure under pressure a little bit in today's session. Now, the advertising giant WPP's sales are bouncing back. That's as global brands restore marketing budgets they'd cut during the pandemic in an effort to get consumers spending again. Joining us now is Mark Reed, the CEO of WPP. Mark, very good to speak to you. So your organic sales number coming in above estimates, above expectations from the broader market. What is it that has been going so well? Let's start there.
Yeah, we came in at 3.1% and the consensus actually was down about 1.5%. We've seen a pretty broad-based recovery, across all parts of our business, across all regions. We saw growth in 15 of our top 20 markets. And I think, as you said, I think clients are seeing a bounce back in consumer confidence or growing consumer confidence. They're looking through the current level of restrictions to, really a very strong economic recovery in 2021. Now, there's no doubt that parts of our business, retail still down 4.5%, travel and leisure down 35% still in the first quarter. So there are parts of the economy where, client confidence is not there. But I do think we'll see that come back pretty strongly as we go through the year.
You have not boosted your guidance, though, for the overall year, Mark, today. And you've also cautioned that there's still a high degree of uncertainty going forward. What is it exactly that you're uncertain about or cautious about? I know we've come through a pandemic, so there's been a lot of uncertainty. But what is it about the recovery that leaves you uncertain?
Well, look, I think that we gave quite a broad range of guidance. We said mid-single digit, and I think we're holding that. Though I think we will expect to be, closer to the upper end of that than perhaps we would have done back in December when we gave the guidance. But there's no doubt that it's really, I think the direction of travel is very clear. It's upward, but the pace of recovery in certain markets is slow. There's a terrible situation going on in India at the moment. And, talking to our India country manager, really, severe lockdown there and impact on people. Western continental Europe, the recovery is probably somewhat slower than it has been here in the UK. I mean, the UK came back 4% in Q1, which despite the restrictions is a pretty strong growth. So I think it's really more about the pace and the speed than it is about the direction of travel.
You mentioned various sectors and how they'd performed in the first quarter. You said travel and leisure was still down for you, Mark. I was looking at the Google results, though, overnight. They showed a surge in ad sales related to travel and also to retail. Does this just reflect a difference in timing across the Atlantic? Is the US just ahead on that recovery?
Yeah, probably the US is a little bit ahead in terms of travel. I think the other thing is that, much of our work is in brand building for travel companies, and that's probably going to take something of a backseat in the short term to measures that really drive sales, where Google will naturally benefit. But as you say, I mean, they had an amazing result, up, I think, a third in their ad sales business, really strong growth at YouTube overall. And that, I think, reflects the shift into digital media. We saw the same thing in our business. E-commerce sales up 50%. Spending through connected television up 90%, much growth in digital media. So I think that in those parts of the media mix, where we work with Google and Facebook and Amazon, we are seeing strong growth as well.
Yes, let me ask you about working with some of those big tech giants. Google and Apple killing the ad cookie is the headline I read this morning. It's becoming harder, perhaps, for some of that data that marketers love to use to get hold of some of that. But some of that perhaps plays to your strengths. Maybe that benefits you. I wonder what kind of new advice and services you're giving to clients as a result of this disruption amongst these big tech firms.
Yeah, look, I think there's no doubt that the cookie allowed a degree of tracking in an online world that we'd never have allowed offline. So I think that moving to a greater degree of privacy for the consumer is the right thing to do. And in the long run, it will benefit our clients. And certainly, clients are turning to us. We launched a new unit, Choreograph, bringing our data capabilities together to advise clients in a privacy-first world how they can use their data responsibly and with consumer permission. And I think in the long run, it's the right thing to do. In the short term, and maybe a little bit painful, I don't think it's going to change the shift of ad dollars into digital media, though, in any way.
Let me ask you about your stock price, and I know most CEOs will tell me, and I'm sure you'll also echo these thoughts, Mark, that you manage the business for the long term and not with a focus on day-to-day share price moves. But thinking about longer-term share price performers, the stock price has risen slower maybe than peers this year. What are you doing at the business to try and close that gap?
Well, look, I think, as you say, we are focused on the long term, and we try not to look at the share price every day. We've had a pretty strong recovery since the nadir of last year. I think our share price has doubled. So I think it's really, perhaps the further you fall, the more you have to rise. So, but as you say, we're focused on the business and really creating long-term shareholder value, and the investments that we're making today in creativity and technology designed to get us there.
We've been thinking a lot about inflation over recent weeks here at Bloomberg TV. Mark, talk a lot to people about inflation and the drivers of it. I wonder what kind of pricing power you have in your business, you're seeing in your industry, given the difficult times of 2020 and the recovery now.
I think we do have stronger pricing power, if that's the right phrase, in the digital parts of our business where, demand is strong. I think inflation, anecdotally has always been seen as good for the advertising business. We'll have to see what that is. But the main thing is, can we invest in those new areas of our business? Because I think that's where we have the opportunity to differentiate what we're doing. WPP was named by Forbes as a leader in e-commerce services recently, and that's a massively growing area of demand from our clients as they shift to seek their sales online.
Mark, thanks very much. Really good to speak to you. Thanks very much for joining us. Mark Reed, the CEO of WPP. Let's get a focus on some of the big stories we're covering here at Bloomberg this morning. A Bloomberg First Word News update. Here's Laura.
Thanks, Anna. The European Commission wants the power to levy fines or block deals by foreign state-owned companies. The proposed rules obtained by Bloomberg seek to answer complaints from European businesses that Chinese state-backed firms get support they cannot match. Chinese business groups have already complained about the draft, which could change before it's set to be proposed next week. Sources tell Bloomberg that President Biden isn't planning to increase the estate tax as part of his tax hike plan. During the 2020 campaign, the president pledged to increase the estate tax along with capital gains and corporate income taxes. Still, his plan will end a major benefit for wealthy estates that reduces the tax. It's time to get back to the office. That's the message from Wall Street titan Jamie Dimon. JP Morgan is the first major US bank to tell its staff they'll need to be back in about 2 months. It says by early July, all US employees will be in the office on a rotating schedule. There will be a 50% staff cap, though, until social distancing rules are relaxed. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London. Coming up on the programme, the future of London. 6.2 million voters decide the next mayor on the 6th of May. Today at 11 a.m, I'll be hosting a debate between Sean Bailey, Sian Berry, Sadiq Khan and Louisa Porritt as they compete to become the city's next leader. We'll discuss their plans for crime, transport, housing and the reopening post-pandemic, hosted by Bloomberg and London First. Hear it on London DAB and on your Bloomberg terminal on Live Go. They are not the only candidates, of course, standing in this. We have a full list of candidates for London's mayor. They can be found on the London Elects website, londonelects.org.uk. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the US, we're seeing unemployment and income losses
affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
Right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, they party, makeup will bounce back.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
Those were some of the world leaders and top executives gathering for the Bloomberg Green Summit, a virtual event focusing on the core issues of climate change. Some really interesting thoughts in that collection for you. Now, the Biden administration has pledged to cut emissions by 50% as the country rejoins global climate efforts. However, while governments announce such ambitious targets, my next guest says that in order for investors to get it right, the focus on decarbonisation must be examined from a total portfolio level. Joining us now is Jennifer Wu, JP Morgan Asset Management's Global Head of Sustainable Investing. Jennifer, very good to speak to you once again. So we'll come to that whole portfolio point in just a moment. I just wanted to reflect on how much more engagement you're seeing from corporates as a result of the new stance from a new US administration. What difference has that made to the conversations that you're having?
Yeah, no, thank you for having me here. So I think it has certainly made a huge difference in our conversation with companies, with now not only the US, but other countries renewing their commitments and actually setting pretty ambitious targets by 2030, as well as aiming to be carbon neutral or net zero aligned by 2050 or 2060. So I think it's sufficient to say that the race to zero has indeed started. And what's really quite different this time is how, like what we're seeing in Europe, right, with the UK government actually enshrining these commitments and plans by setting up laws. So we're really hoping to see a paradigm shift in how companies should be planning CapEx for the next 3, 5, and 10 years from now. And I think the other thing that's also important is that we're also starting to see companies in some of those hard-to-abate sectors that are also carbon intensive, such as aviation, shipping, and industrials, starting to have conversations around how to decarbonize their business operations, right? And these are, as you would know, sectors that really require innovations in technology. So again, government plays a very critical role here in providing incentives for those to be developed. I think at the end of the day, from an investor standpoint, actions are critical, right? Governments have set these targets, but how do we actually get there? What legislations are they going to be introduced is going to be critical.
When I talk to some airlines, Jennifer, not all, but some airlines focus on the per passenger sort of levels of pollution that are created and focus on the energy efficiency of their aircraft. Is that going to be the full story when it comes to that kind of industry? Or are we going to be talking about reducing carbon emissions by some other metric?
I think we need all different kinds of measures to actually get to some of these targets that governments are setting. So, right, the concept of polluters pay is going to dominate how the economy is going to develop over the course of the next 10 years, right? This is not a concept that's going to go away. And then in addition to that, the whole race to developing greener and cleaner technologies will also have to come into play, because otherwise it's going to be very difficult for us to actually get to net zero, right? Putting a price on carbon is one thing, which will provide incentives for consumers as well as corporates to become more efficient and potentially travel less, if you like. But at the end of the day, to really remove emissions or drastically reduce what's in the atmosphere requires better technology, right? We need to reduce the actual emissions by way of, employing different kinds of technologies in the aviation sectors by potentially, switching to alternative fuels, not in the near term because the technology is not necessarily ready yet, but definitely over the course of the next 10 years such that we can actually get to a, say, 55% of reduction or even more by 2030.
Yeah, this is a good example of an industry that will need old-fashioned fuels, if we can call them that, hydrocarbons, into the future, certainly in the short term, Jennifer, as we try to transition and try to find alternatives. How have we progressed in our understanding of the possibility of assets becoming stranded, though? Because whilst there will still be demand for those older technologies, there is a tendency amongst many asset managers to try to avoid things that don't do well on an ESG score. So how do we understand stranded assets at this point, and what kind of funding is going to be available to those kinds of sectors?
Yeah, I think it's a really good question. I think the most important message to take away for investors is that corporations are actually going to react very quickly to these legislations, and many of them have already started doing so. So the incorporation of the transition to a net zero economy has to be front and center for us as we think about ESG broadly, right? So the way I think about it is that in the past few years, we say ESG is everything, but climate needs to be everything now. And the hard work is really ahead of us, because companies are trying to figure out how to decarbonize their operations. We also need to look at, to your point, stranded assets and a pathway to total portfolio view. It's really challenging, because if we look at very near term, say in the next 10 years even, the reality is the projection for global GDP is still continue to grow. And, some of the largest emitters in the world, like China, for example, who consumes more coal than any other countries, their commitment is to get to peak emissions by 2030, right? That's what that means is that overall emission is likely going to be on the rise in the next 10 years as well. So from a pure corporate standpoint, what you're looking at is if you're an oil and gas company, it's good business, right? If I look at the very near term, because economy still needs oil and gas as fuel to really make sure that we can continue to manufacture and produce in the way that we want. So I think what's required is legislation, right? Put a price on carbon is going to be critical, and I think that's what COP26 should really be focusing on, right? And then also, more importantly, how do the countries collaborate so we don't go back to the old way of developed markets starting to export, although they can't really do that now, carbon intensive industries to less developed world, which really is not going to create a net negative impact on carbon emissions by 2030.
Yes, trying to avoid a situation, I suppose, then of regulatory arbitrage. Jennifer, thank you very much. Thanks for joining us. Good to speak to you this morning. Jennifer Wu, JP Morgan Asset Management's Global Head of Sustainable Investing. No doubt more from Jennifer as we head towards the COP meeting later on this year. Let's get a Bloomberg Business Flash. The top corporate stories we're covering this morning. Here's Laura.
Thanks, Anna. Starbucks global growth fell short of expectations. Gains were expected across all regions after the weakness of last year's lockdowns, but global same-store sales only increased 15%. That's overshadowing a rebound in the coffee giant's key markets outside of the US and China. Deutsche Bank has seen its best quarter in 7 years. The German lender is raising its outlook after fixed income traders outperformed most of their Wall Street peers. Deutsche Bank also dodged losses from the collapse of Archegos Capital Management. Santander's had a boost in its bid to restore profitability eroded during the pandemic. The bank saw its US earnings jump while booking lower costs and charges. Underlying profit jumped to the best results since the second quarter of 2010. Santander is shedding thousands of jobs in Spain and shutting a fifth of its UK branches. That's the Bloomberg Business Flash. Anna.
Laura, thank you. Laura Wright here in London. Coming up on the programme, Wall Street prepares its return to the office. Jamie Dimon becomes the first executive to bring his US employees back into the building. We discuss that next. We'll get the latest. This is Bloomberg.
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I've seen how computing power had been growing at an exponential rate, and memory storage and disk storage all have been growing very rapidly. But batteries and energy storage have been growing at a very, very slow rate of about 3, 4, 5% per year. So it takes about 20 years to double energy density in batteries at that rate.
That was the QuantumScape CEO, Jagdeep Singh, the company turning heads with its claim to have built a next-generation battery that could increase the range of an electric vehicle by as much as 50%. You can read more about this firm in the Big Take special. That is on the Bloomberg terminal and on the Bloomberg website. Now to the story that we mentioned before the break. JP Morgan has become the first major US bank to mandate a return to the office for its entire workforce in the United States, this is. In a Tuesday memo, staffers were told to start making arrangements. Joining us is Danny Berger. And Danny, how soon are JP Morgan employees expected to get back into the office? This isn't everybody in every day, is it?
No, it's definitely not. And the time frame that they've given their employees, as you say, in the US is in July. So let me read from you from the memo that was sent out out yesterday. It says that they would fully expect by early July, as I said, all U.S.-based employees will be in the office on a consistent rotational schedule. So that rotational schedule bit, that's really one of the key things here. Because of social distancing guidance from the government, they can't get everyone back at once. So their plan at the moment is to get at most 50% of people in. In terms of protections once they're in, they are encouraging people to get the vaccine, but they're definitely not mandating it. This isn't altogether surprising considering that Jamie Dimon, since really September, he's been very public and vocal about the damage that work from home does, not just economic damage, but social damage as well.
Yeah, and certainly we've heard from other U.S. banking executives, at least with some strong thoughts. Does this mean we'll likely see other Wall Street banks then following suit?
I think that that is likely, Anna. And as you say, we've heard from other executives who have voiced similar things to Jamie Dimon. I think the question here is, what model do they choose? Do they choose the big bang, as one former JP Morgan executive put it, of getting everyone in at once? Or is it more easing in? David Solomon, again, he has called this an aberration, the fact that people are working from home, that they're going to correct as soon as possible. So we're basically just waiting to see what model Goldman takes here in getting people back, Anna.
Yeah, okay. Thanks very much to Danny Berger there with the US story. Here's a little bit of a take on the European banking story around this very theme. Deutsche Bank sees flexible working for up to 3 days a week. That is the comment coming through from von Moltke, who we heard from a little bit earlier on the earnings story. The opening of New York and London offices will come in the next months, he says. He sees a range of 40 to 60% for flexible working. So some interesting commentary coming through from Deutsche Bank when it comes to offering flexibility in terms of work location. That is it for the European Market Open. Surveillance early edition is up next. European equity markets then fairly mixed actually this morning. A mixed bag. US futures a little lower. This is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
United States stock market is very overvalued on virtually every metric.
The bottom line is clear. If you're vaccinated, you can do more things more safely.
For vaccinated people, outdoor activities without a mask are safe.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance, the Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Deutsche Bank posts its best quarter in 7 years, confirming it dodged the fallout from Archegos. Santander reports decade-high adjusted profits. Our interviews with the CFOs coming up. The big buyback, Alphabet revenue blows past estimates. Google's parent says it will repurchase $50 billion of shares. And Bloomberg learns that President Joe Biden will not expand estate taxes ahead of today's funding proposal announcement. Well, good morning, everyone. It's Wednesday, so topple day. You can say it's halfway through midweek. Now, let's get straight to the top stories, and it's about banks. Deutsche Bank has seen its best quarter in 7 years after its fixed income traders outperformed most of their Wall Street peers. The German lender is raising its outlook and says it's on track with its dividend plan. I think we're having a couple of technical difficulties. I said it's Wednesday, it's halfway midweek, and that's what happens usually when you're too confident about getting through the weekend without any hiccups. Now, we spoke to the Chief Financial Officer of Deutsche Bank, James von Moltke, really confirming that the lender dodged losses from the collapse of Archegos Capital Management. It was a good conversation. Our bureau chief over in Germany did that. At the same time, and this is what we want to look at the same time, it's something that we need to keep a very close eye on, because he further talked about what was to come. Okay, so we have a lot of banking stories. We have Santander. We also have Nomura with some changes at the top, and then we have Deutsche Bank. So to round everything up, here's our Danny Berger. Hi, Danny.
Hi, Francine. Look, I'm here. I'm ready. I'm roaring to go. I think it's sort of a strange thing that's happening with banks, because for a lot of earnings, we've seen that expectations were really high in the market. I mean, think about Tesla. We talked the other day. It didn't move despite the big beat. But look, when we're seeing banks in Europe beat, they are moving. So Deutsche Bank, the big one, up almost 6% at the top of the board for the stock 600. Lloyd's as well, both of them beating. Deutsche Bank, this huge FIC trading number. So overall, the best performing sector today is going to be the stocks bank index. It was higher by more than 1% at one point. But let me flip up the boards and show you banks that didn't report earnings today, but still are in the green. We have German banks, perhaps sympathy with Deutsche Bank there. We have NatWest, perhaps reflecting Lloyd's. And we have the French banks as well. BNP is due to report soon. And I think that expectations being low is really reflected through the screen. All of a sudden, you're in this moment where investors are saying, hey, okay, maybe European bank earnings are going to be stronger than we expected. Maybe the picture is sustainable, and they too will have very strong trading numbers like their U.S. peers, perhaps even stronger, considering Deutsche Bank gained 34% in their FIC trading. That compares to an average of 17. So, Francine, I think one of the big equity stories in Europe today is a repricing of these banking shares.
Yeah, and it'll be interesting to see going forward, actually, with some of the other ones, the big ones, also reporting. Danny, thanks so much, and actually great work for all of the earnings season banking news that you've had to cover. Now, Google sees a surge in ad sales as businesses look to capitalize on their economy reopening. First quarter revenue for parent company Alphabet came in at about...
Morning, traders. Looking to trade today. I placed an order to sell short British pound. The price I'm looking to sell, 138.77.5. It's right here. So if you're looking to sell and trade British pound, here is your chance. You can place an order and follow my trade. Stay with me, and we will go through from the beginning to the end. We will trade this pair. Okay? I'll speak to you later.
Suspend it, and clearly, returning it to shareholders is the only thing you can really do at scale, given you're not allowed to do that many, at least they're not particularly obvious, transformative deals. So in a sense, shareholders are benefiting from regulation.
Alex, not everything was rosy for Alphabet. What was the spot that we should be looking at a little bit more closely?
Well, I mean, look, Alphabet is clearly just the parent of Google. Most of Google's revenue comes from search, and that is overwhelmingly good. It is recovering. That was something that this time last year didn't look so promising because people weren't, looking for, weren't searching the internet for holidays, for big ticket purchases, and that meant there was no need to advertise for them. And as we know, Google gets most of its money from search ads. Now, that business is now recovering. People have a lot more disposable income, and they're looking for ways to spend their money as the lockdowns ease. There are other parts of the business which, they have been growing, but perhaps not as well as might have been expected, not least Google Cloud. It still struggles to compete a little bit with Microsoft and Amazon. And then, the business that never makes any profits at all is, of course, the other bets. That's things like their healthcare ambitions. They still make, a $1.5 billion loss.
Alex, we're also expecting more earnings. We have Facebook and Apple. Are they both expected to beat?
Well, I don't know if we can say whether they're expected to beat or not. They're expected to have, good numbers. Clearly, the recovery of the advertising industry is very good news for Facebook. As I said, disposable income means that people have more money to spend on the hardware that Apple sells. The question, I think, is going to be, the thing I'm really looking to hear is Mark Zuckerberg's comments on the crackdown on online tracking that is happening both on mobile devices from Apple and on web browsers from Google, the extent to which that is affecting Facebook's business going forward. Even with that, I think there's a good chance that the advertising spending is more than offsetting any concerns and wrinkles that might be emanating from those increased headwinds.
Alex, thanks so much. Alex Webb there, Bloomberg Opinion Tech columnist. Now, coming up ahead of today's Fed decision and Joe Biden's funding proposal in Congress, we also have a Bloomberg scoop. The president will not be expanding estate taxes, so that's what we'll be discussing next. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
We have lost too much time. China has resumed its growth. The US is booming. The EU must remain in the race.
French Finance Minister there, Bruno Le Maire, urging the European Union to speed up disbursements from the flagship stimulus package so the bloc can keep pace with America. But ahead of Joe Biden's address to Congress and a policy decision from the Federal Reserve, some investors are cautious on the region. Well, Jeffrey Gundlach of Double Line Capital told Bloomberg that U.S. stocks are overvalued in every measure and that the Fed's stance on inflation is nothing more than guesswork.
We don't know. Nobody knows. Most concerned about the fact that the Fed thinks they know. There's plenty of indicators that suggest that inflation is going to go higher and not just on a transitory basis for a couple of months. So we'll see. That's how I think the Fed is trying to paint the picture, but they don't really, they're guessing.
Well, joining us now is James Lord, Morgan Stanley Global Head of FX EM. James, I have a million questions, especially on what we'll find out in terms of GDP and actually how the Fed will position themselves today. I mean, what investors and what Dollar really wants to know is when will they start talking about possibly tapering?
Yeah, sure. Hi, Francine. Thanks very much for having me on the show again. Well, we think that this evening's Fed meeting, it's just too early for them to be making any significant changes to the language. We think that will come in the summer, potentially at the July meeting, for them to signal that sufficient progress has been made in order to signal tapering to start in January 2021. So we think there's a little bit more time here. We think there's still a window for US bonds to sort of stabilize, potentially even head a little bit lower if they redouble down on that dovish message today. We just think it's a little bit too early for them to be making any big changes.
James, I mean, one of the big questions, and actually I've seen quite a lot of notes from banks today on trying to figure out with the Families Act plan, right, from the U.S., how much funding can the U.S. still do? So this goes back to exactly, where we are on the U.S. 10-year. If it's at 1.6, as it currently is and stays there, do they still have room to maneuver?
Yeah, absolutely. I think there's, levels of interest rates are far from being at a point where it would cause any concern about the ability for the U.S. government to further expand its deficit. I mean, we think that potentially we'll see what details are announced, but our base case assumption is that in year one of the American Jobs Plan and the American Families Plan, you'll see a sort of net deficit expansion in the range of between 250 to 500 billion. And we're waiting to see more details to kind of further shore up those numbers a little bit. But ultimately, that should be something that with the Fed continuing to do purchases, even if they begin tapering next year, it's something that the market should be able to absorb, in our opinion.
So how difficult is it to see exactly what Dollar does on the back of it? So at the moment, we have, I think, 2.25 trillion in terms of infrastructure spending. It's over 10 years. And then we'd have an extra 1.8 because of the Families Act plan, which we'll know more about later.
Yeah, so I think the dollar, I mean, if we see Treasury yields start to break above the recent range, above 170, then this will clearly put some upward pressure on the dollar. But I think investors will be paying probably a little bit more attention to the Fed meeting, and I think that will ultimately control how much the dollar would react to any aggressive deficit expansion from the Treasury. So I think if our view on the Fed comes through and they just continue to hammer home the message that it's just too early to be making any major changes, then it should keep the yield curve under control. It should keep the dollar under control. If anything, reinforcing that message today could see yields head down a little bit from here, with potentially seeing 10-year down to around 140 over time, which would give a little bit of downward pressure on the dollar as well.
James, what do you worry about in the U.S. economy? So we have GDP later this week. There seems to be, I guess, possibly a mismatch about, the rollout of the vaccine that is a great success in the U.S., but actually the uptake of the vaccine with lower numbers than in the U.K. So do you worry about vaccine and lockdowns, or do you worry about runaway inflation?
Well, we're worried about both, really. I mean, both are risks to the outlook. I mean, our U.S. economists are certainly flagging that there is a risk of an inflation overshoot.
Okay, traders, position opened. Short position on British pound at 138.77.5. All of you guys who decided to trade British pound today with me, stay with me, follow this trade, and we will finish, we will close this trade with profit. How much you will make, I cannot tell you, but I know for sure that we'll make profit from this trade. Okay, I'll speak to you later and stay safe.
A bit of time before we will really have to worry about either of them, because in the short run, any high inflation prints will be largely dismissed as sort of transitory by the market and potentially the Fed. And you know, the vaccination rate, whilst it's softened a little bit, is still pretty high. And you know, the J&J vaccine is being rolled out again in the US, which may help. And I think there's still some way to go before I think being too concerned about vaccine hesitancy really, you know, causing damage to the outlook.
James, thanks so much. James Lord there of Morgan Stanley stays with us, and we'll talk a lot more about emerging market currencies next. Now, let's also get to the Bloomberg First Word News. In London with me is Leanne Gerrans. Hi, Leanne.
Hi, Francine. In the US, President Joe Biden is urging Americans to get vaccinated. He is pointing to new guidance that people who have been inoculated can now socialize indoors without masks. The change in rules might help convince people who have been hesitant about getting their shots. According to Bloomberg's vaccine tracker, about 140 million Americans have had at least one dose of a vaccine. Now, the European Commission wants the power to levy fines or block deals by foreign state-owned companies. The proposed rules, obtained by Bloomberg, seek to answer complaints from European businesses that Chinese state-backed firms get support they just cannot match. Chinese business groups have already complained about the draft, which could change before it is set to be proposed next week. And it's time to go back to the office. That is the message from Wall Street titan Jamie Dimon. JP Morgan is the first major US bank to tell its staff they will need to be back in about 2 months' time. It says by early July, all US employees will be in the office on a rotating schedule. There'll be a 50% staff cap until social distancing rules are relaxed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Now, India battles its worst coronavirus surge in the world. The official death toll surpasses 200,000, but experts believe the actual number may be higher. Later on in the program, we speak to one of the country's leading biologists, and if you have any questions for him, just IB us at IB plus TV Go. Up next, we discuss the impact of India's second wave with James Lord. This is Bloomberg.
Stop on profit for British pound. I'm going to place stop on profit at 138.75.5. Okay, stop on profit placed, and whatever happened, like I always say, you will not close this trade with loss. Okay, so you guys, please place stop on profit, and if it will change direction, it will close at this price and you will have 2 pips in profit. It's all about how much you get per pip. If you trade on margin, you can get not just $1 or £1, as you know. Well, you probably, not many people trade imaginary money. Most of you probably, I believe, trade real money. So you will see, broker will let you know, or you already know how much you pay per pips. Okay, in our case, we broker pays us £100. So if it will change direction and if we decide to move up, we will get £200 in profit. We'll call straight with £200. I'll speak to you later. Okay.
Joe Biden, nearing 100 days in office, addresses a joint session of Congress. COVID, the economy, the plan forward. Wednesday, 8:30 p.m. on a special edition of Balance of Power on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now let's get straight to the banks. And Deutsche Bank has seen its best quarter in 7 years after its fixed income traders outperformed most of their Wall Street peers. Now the German lender is raising its outlook and says it is on track with its dividend plan.
It's always, difficult to simply annualize a first quarter, but our accruals are actually mechanical, subject to some rules that the ECB has laid down. So there's not too much messaging in that. But I think the encouraging thing is, with 300 million of an accrual for distributions already done in the first quarter this year, and of course we'll continue to accrue from profits in the remainder of the year, we can begin to show the first installment of the capital return that we promised investors.
Deutsche Bank CFO there, James von Moltke, also confirming that the lender dodged losses from the collapse of Archegos Capital Management.
We did see an event with a prime finance client late in the first quarter. As we said, we were able to exit the collateral positions without a loss. In fact, we were able to return excess collateral to the client. We're very pleased with the way our risk management function through the process, both in advance of the market events and then in the liquidation and managing through that event.
Now, at the same time, Santander delivered its highest profit in more than a decade. The bank booked a 500 million euro restructuring charge for the quarter as it continues with its post-pandemic cost-cutting drive. The chief financial officer, Jose Garcia Cantera, said the outlook was positive.
No, this is the entire restructuring charge that we expect for the year. So we wouldn't expect to have more restructuring charges. These correspond mostly to the UK and Portugal. But again, this is what we expect for the whole year.
Let's turn to tech now, and Google also sees a surge in ad sales as businesses look to capitalize on the economy reopening. Now, first quarter revenue for the parent company Alphabet came in at over $45 billion. The firm also unveiled a $50 billion buyback, which sent shares higher in extended trading. Well, tech earnings are in full swing. Google reported a surge in ad sales as businesses and unveiled a $50 billion buyback. So that's exactly what we were explaining. At the same time, Microsoft earnings topped estimates for the 9th straight quarter. So a lot going on with these two companies, and we also have Facebook and Apple after the bell today. Now let's check in on how the tech giants are trading in the pre-market session with our Danny Berger. Danny, a lot to look out for.
Definitely, and you really put this just in perfect context for me, because it really is a tale, as I wrote up here, a tale of two different tech giants. You have Alphabet pre-market surging more than 4.5%. It looked very similar in aftermarket trading too. And this was a really positive earnings for Google, because before, a lot of its ad sales, they stayed strong at YouTube, but it really is that internet searches which are important. And so this is just a good barometer for businesses in general, that they're spending again. But of course, it's that $50 billion buyback, Francine, which is really boosting earnings. At the same time, Microsoft beating 9th straight quarter, but because its market cap had gotten to something extreme, I think people were really looking for an earnings that was better than what was expected. I know it's a little strange, you beat expectations and you fall, but just generally this earnings season, people want to see companies beat expectations to a really large degree and give a forecast that's also just spectacular given.
That's it, guys. It's all about day trading. It's all about fast money to get trades, to get a relatively small amount of profit, but many times. You just can't imagine if you have, we have many screens. We trade almost all major Forex pairs, also CFDs on FTSE 100, Dow Jones. Probably every minute some trade happened within our company. So in this case, you can see only one screen, and as you can see, we closed position on British pound. I'll show you where, and just right here, we have £200 in profit. It took us 1 minute candle, stick 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 minutes to close position in profit. For you guys, you're already well done. You made your trade, first trade. Let's move on. Let's not stick with one winning. We need to win a lot of trades today, okay? And if you want to find out more about how we trade, about our strategy, you need to go to company.co.uk and purchase this strategy. We also provide webinar that we will have, by the way, today, webinar at as far as I remember, 11 o'clock UK time after trading hours. But Forex never sleeps, so you can get access to real-time webinar, and I will show you everything I know how to trade, how to use my strategy. And afterwards, you can practice for a couple of weeks because we provide live trades for free. And then you can go and trade different pairs. You don't have to use only pairs we show you on the screen. Okay, anyway, we close trade. We have £200 in profit. Let's move on. Well done, guys. And I'll speak to you later.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Wednesday, the Fed decides. The Fed is on hold waiting on inflation. But for how long? Coverage begins 2 p.m. on Bloomberg Television.
Deutsche Bank posts its best quarter in 7 years, confirming it dodged the fallout from Archegos. Santander reports decade-high adjusted profits. The big buyback Alphabet revenue blows past estimates. Google's parent says it will repurchase $50 billion of shares. And Bloomberg learns that President Joe Biden will not expand estate taxes ahead of today's funding proposal announcement. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Wednesday, 28th of April. I'm Francine Lacqua here in London. Now, U.S. President Joe Biden is set to make his first speech to Congress after almost 100 days in office. The president is expected to highlight his progress against the pandemic while calling for bipartisan support on his $2 trillion infrastructure package. But plans, or actually sources, say he will abandon his campaign promise to increase estate taxes as he unveils funding measures for his American family plan. Well, joining us now is our D.C. morning editor, Kathleen Hunter. Kathleen, what a big day, of course, for the markets and for President Biden. How significant, first of all, is the speech tonight?
Well, I think it's going to be potentially hugely significant. I mean, it's an opportunity for the president to speak directly to the American public. We know that there's not been a lot of Republican support so far for the types of things that the president has talked about doing. And so I think the strategy here is really to make the case directly to the public and try to get a groundswell of public support for these types of initiatives. Obviously, the types of things Biden is talking about might not be very popular with wealthy people, but certainly is focused on helping working class families and the middle class. And I think that that's something that I think represents a shift somewhat in the role of government in American life, but something that Biden is firmly behind at this stage.
So how will it differ from other presidential addresses to Congress? I mean, he's spending money, and he's actually spending quite big. We're talking $2.25 trillion for the infrastructure plan over 10 years, and this would be an extra 1.8.
Exactly, and it's also important to remember it comes on top of the $1.9 trillion pandemic relief package that was signed into law in March. So we're talking about very big numbers here across the board. I think that, it's going to be different philosophically, I think, in that Biden isn't shrinking away from the idea of spending big and expanding the role of government. I mean, big government is definitely back when you look at the White House, and that's certainly a shift from what we've seen over the last really 4 decades, going back to Ronald Reagan. Just logistically, it's going to be a bit of a different speech because, it's the first major indoor event we're seeing at the Capitol since the January 6th insurrection. So there's going to be real restrictions, both related to security and related to COVID-19. So there's not going to be a full chamber of lawmakers. There's only going to be about 200 people in attendance. So it's going to be a bit of a different type of atmosphere. And I think it's going to be, I think that does reflect that this is really a speech that's meant for the American public. It's meant to be telecast across the U.S. and not necessarily meant for the members of Congress that are sitting in the chamber as much.
Kathleen, of course, the president is also raising taxes to pay for it, but what kind of response are we expecting from Republicans?
Well, Republicans, are already talking about a lot of what's in this plan. We're learning the details over the last couple of days. We'll learn still more this evening, perhaps. I think a lot of what the president is talking about doing has been out there and telegraphed for many weeks now. And we've already heard from Republicans, a drumbeat that that these are massive tax increases, that it's spending that doesn't have to do, that it's unnecessary spending. And I would expect that we would hear those types of criticisms continue as we, move forward and Congress begins to take up the plan.
Thank you so much. Our DC morning editor there, Kathleen Hunter. Now, India battles with the worst coronavirus surge in the world. The official death toll surpasses 200,000, but experts believe the actual number may be higher. Up next, we speak to one of the country's leading biologists. If you have any questions for him, just IB us at IB Plus TV Go. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now, India's second wave of coronavirus continues to worsen with no clear end in sight. International aid is en route with desperately needed hospital equipment making its way to the country. President Biden told Prime Minister Modi he intends to send vaccines from the U.S. to India, but did not specify timing for a decision or shipments. Now, the world's worst second wave has seen the official death toll surpass 200,000, though experts believe the actual number may be higher. Despite being one of the world's largest vaccine manufacturers, only 1.8% of the population is fully vaccinated. Well, joining us now from Pune in India is Lingadahali Sashidhara. He is Ashoka University Dean of Research and Professor of Biology. Professor, thank you so much for joining us. First of all, how did we get here? India had a first wave in 2020, and a lot of people thought that actually you had reached more or less herd immunity. What were the missteps or the variants that has led to this awful and tragic situation today?
Okay, so if you remember when we had a severe lockdown, large number of people are working in big cities. They moved out toward the rural areas. And then the lockdown was lifted. They all came back to the cities. And much of the infection that we had in the first wave is mostly in the major cities. And the people sort of came back and then started getting infected. And initially there was a silence, slow spreading. Many deaths were a bit low, so people didn't realize that the infection is spreading, particularly in December, January. And then sort of, it started peaking, and now we are facing a major crisis. It was sort of predictable, and it's our failure that we didn't predict well.
Okay, so we're now April 28th. What is the right way of dealing with the crisis now? Apart from asking for urgent medical equipment being sent from abroad, I guess, broadening out the hospitals, what should the Prime Minister do now?
Well, I think we have to reorganize our facilities better. In fact, now somehow we have to manage the crisis with the international support, particularly for the medical equipment, oxygens, cylinders, ventilators, and so forth. But if it starts spreading to our tier 2 and tier 3 smaller towns, and that's where we need to be internally, completely self-sufficient. And I think we need to ramp up our oxygen production plants, oxygen cylinders, and all the medicine supplies. And of course, we need to ramp up our vaccinations.
Professor, is there a danger that, and this was one of the concerns in the UK, as the number of infections rise really significantly, is there a danger that if you vaccinate at this exact time without going into full lockdown for at least a couple of weeks, you can create actually even more dangerous mutations of the virus?
Well, lockdown is now going to sort of slow down the vaccination. Vaccination is still continuing even during the severe lockdown. But I think there is still a worry about the new variants. Already there is an Indian variant. We are talking about what is called double mutation. If there is a new variant which is so different, then it may even escape immunity or the immunity induced by the vaccination. That's going to be dangerous, which is unlikely, because if you look at the way the biology of the virus, the spike proteins, if it varies too much, it will not be able to enter the human system. And so there are certain limitations to the virus itself, how much can vary. And I think most of the known vaccines people have simulated looks like it's going to protect a very large number of variants of the virus.
Professor, if you look at exactly, what you're living through in India, is it also the younger that are being affected? Like, what can you tell us about what it's like on the ground? We keep on reading.
It's extremely stressful. Yeah. It's extremely stressful to see people dying because of lack of oxygen supply. It's not because the infection fatality or case fatality is very high. In fact, it should be less than 1%. And we are now experiencing more than 2% case fatality simply because we are not hospitalizing the patients early enough. We are not providing the medical care early enough at the right time. I think it's a system failure. I think we are all to be blamed. It's extremely stressful to see people die, extremely stressful.
Is it affecting the young in a disproportionate way to what you were to what we thought in 2020?
It's definitely younger than what we've experienced in 2020. 2020, the most of the people who died were 60 and above. Now it is between 45 and 60. That age group is sort of dominating the deaths. Still, the 60 and above are, at a higher rate, but because there are so many of them already vaccinated, that rate is coming down, particularly in April. And 45 and 60 age group is now more vulnerable.
How do you explain that, Professor? I mean, is it impossible to explain actually what's shifted to make much more?
Well, we do not have
45
enough
and
biological
66?
evidence. Yeah, sorry. We do not have sufficient biological evidence for this, particularly perhaps the new variant that we are all, for example, in places like Pune, the new Indian variant is dominant. In places like Delhi, the UK variant is dominant. Perhaps being able to cope with these two kinds of variants, and even younger people are succumbing to the infection.
All right, let's hope it gets better very, very quickly. Lingadali Sashidhar there, Ashoka University Dean of Research and Professor of Biology, joining us today. Now, coming up, Sweden's economic rebound helps the SMB beat estimates. So we go back to some of the corporate stories and some of the macroeconomic stories that we've been watching. The bank unveils a private wealth arm to cater to the growing number of rich people in Scandinavia. Up next, we speak to the chief executive. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
And I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the US, we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy, and we need companies to step up.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Microsoft beat expectations for a 9th straight quarter, but this time investors were just not satisfied. Shares were lower in extended trading despite a jump in cloud sales. The software giant's market cap had been flirting with $2 trillion the past few days, and many investors were looking for an even bigger blockbuster quarter. Now, Deutsche Bank has seen its best quarter in 7 years. The German lender's raising its outlook after fixed income traders outperformed most of their Wall Street peers. Deutsche Bank also dodged losses from the collapse of Archegos Capital Management. The lender is working on a flexible return to office policy, allowing staff to work from home for up to 3 days a week.
It's a range of 40 to 60%. We think that of flexibility, and it'll really be up to the employee, but in a structured way with the manager, so that we sort of know when people are expected to come to the office, and we're pleased with the way in which we've been able to formulate that process.
And global growth at Starbucks fell short of expectations. Gains were expected across all regions after the weakness of last year's lockdowns. But global same-store sales only increased 15%. That is overshadowing a rebound in the coffee giant's key markets of both the US and China. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now let's get today's Bloomberg Big Take. Batteries are all the rage as the electric vehicle space gains momentum. And one Silicon Valley startup, QuantumScape, is turning heads with its claim to have built a next-generation battery that could actually increase the range of an electric car by as much as 50% and could cut charging time to less than 15%. QuantumScape CEO Jagdeep Singh recently spoke to Bloomberg News' Akshat Rathi.
If getting a third-party lab to test our cells would get rid of these kinds of random attacks, it'd be something that we consider. Do you really think, Akshat, that if all the data we had shared had in fact been generated by a third-party lab, that anything would have been different about that particular report? Because that report was not interested in the facts, right? I mean, let's be honest here. I mean, first of all, I want to be candid, right? There is a legitimate short thesis you could have about QuantumScape, right? And that short thesis would be around, well, this is great. It demonstrates some amazing results in terms of the capability of these cells, but they still have yet to scale up the production and the factories and the time that it takes, all that. And those are uncertainties. And so somebody could say, you know what, I believe that's going to be harder than they think. Legitimate point. We don't argue with that because they're entitled to that opinion. The problem is that's not what the short seller was doing. He shorted the stock most likely on a Wednesday. On a Thursday morning before the market opened, he published a report full of lies, misinformation, and innuendo. Later that day, as the stock price dropped, he probably covered his short already. So he was already gone from the market. This had nothing to do with a belief that the company's fundamental risks were fundamental. This is about essentially market manipulation, and that's what I have a problem with. So I'm not sure that a third-party lab, having tested these results, even if all the data in our presentation came from a third-party lab, would have changed that particular scenario. But I'll be honest with you, we don't intend to have our strategy be driven by a random short seller looking to profit on the markets. However, the questions you're bringing up for people like you who are legitimate observers of the industry, if it makes you feel more confident in the data, that is something that I think we will in fact consider.
What do you imagine the future of lithium-ion batteries? Not 2025, when you might be able to get into a car, but 2030 and 2035 and 2040.
Well, give me a couple quick points here. One is that because battery chemistries are so long-term in nature, they don't change very rapidly. Again, as we discussed at the beginning, lithium-ion in its current form has been around for about 30 years with relatively incremental changes over that period of time. It's not impossible that lithium metal with solid state could drive another few decades worth of battery technology with relatively small improvements to what we're doing today. So we think what we're doing is so fundamental that it could easily be the basis for the next 20 years of battery improvements or beyond.
Well, that was QuantumScape Chief Executive Jagdeep Singh. The company turning heads with its claim to have built a next-generation battery that could increase the range of an electric car by as much as 50%. You can read about the company in the Big Take special on the Bloomberg terminal and website. Now to the banking story. And Deutsche Bank has seen its best quarter in 7 years after its fixed income traders outperformed most of their Wall Street peers. The German lender is raising its outlook and says it is on track with its dividend plan. I think we were hoping to hear from the Chief Financial Officer of Deutsche Bank, James von Moltke, but we'll bring you that story a little bit later. He also confirmed that the lender dodged losses of a collapse of Archegos Capital Management.
Did see an event with a prime finance client late in the first quarter. As we said, we were able to exit the collateral positions without a loss. In fact, we were able to return excess collateral to the client. we're very pleased with the way our risk management function through the process, both in advance of the market events and then in the liquidation and managing through that event.
At the same time, Santander delivered its highest profit in more than a decade. The bank booked a 500 million euro restructuring charge for the quarter as it continues with its post-pandemic cost-cutting drive. Now, the chief financial officer said the outlook was positive.
So this is the entire restructuring charge that we expect for the year. So we wouldn't expect to have more restructuring charges. These correspond mostly to the UK and Portugal. But again, this is what we expect for the whole year.
Well, over in Scandinavia, Sweden's economic rebound has helped lender SEB beat estimates. The bank has indicated that its client base is growing wealthier, prompting it to adjust its business. That's why SEB has unveiled a private wealth arm to cater to rich clients across Scandinavia. Well, joining us now from Stockholm is Johan Torgeby. He's the SEB Chief Executive Officer. Johan Torgeby, thank you so much for joining us. When you look at some of the capital buffers that are required at the moment, should financial authorities actually loosen the reins a little bit on these, and especially on dividends, before the planned September 30 deadline, given the pretty encouraging news we had from banks?
Yeah, I mean, I don't think it's necessarily a timing stress. I think the September date, which is what we are operating under, is fine. I think we have an annual cycle to adjust the capital structure through dividend or share buyback, and I think that's fine. But I think it's very clear that we go into a more data-based approach this time, rather than just having one size fits all.
So what exactly is your preference right now? Would it be a share buyback or a special dividend?
No, I think we would start. We've just announced last quarter a new dividend policy. So the basis is for us to pay out 50% of the distributable income that we earn in a year, and then have the dividend share buyback program as a flexible tool to adjust this also during the year, should retained earnings increase or not. They can also be adjusted from growth opportunities you might identify in the market and you want to pursue. So the adjustment will take some time through dividend and share buyback, but right now, no clear answer on how.
Johan, give me a sense of how you're thinking there of share buybacks. Would this be a last option, or is it something that we should, that you're considering for, 2021?
No, we would consider it for 2021. It's not the last option, but we would always start with the dividend policy being, let's say, fulfilled, and that is the 50%. If we pay out 50% of retained earnings, we then have a capital buffer target from the board of having 100 to 300 basis points of buffer to the minimum capital requirement. In order to adjust to come into that type of, call it, fairway range, we may use share buyback. So it's the adjustment on top of the dividend policy.
Give us a sense of how you became the go-to bank for SPACs in the Nordic region.
I think that was a very kind acronym. I think we've had very few, and we might have been involved in the first one. So we'll see where this goes. But I think we have a very strong position in corporate and investment banking, and hence this has a very international connotation. We, of course, try always to be the most international corporate bank in this part of the world, and I would assume those two things have played well in this aspect.
If you look at some of the things that you've announced, which is, for example, a private wealth unit, why now? Is now the right time to make a name for yourself in this space?
Well, as I would recall or describe the long-term history of SEB, private banking has always been a very strong area and something part of our DNA. In the last kind of 10 years, we've identified quite clear new trends around savings and investments, one of which, of course, very many successful entrepreneurs have done very well in the Nordic region. We also see a succession in generation where the new savers and investors of the world are much more digitally inclined than in the past, and we think we have not performed as well as we want. This has been a very important area of the bank, and the name change from private banking and private wealth management and family office is just to be more clear and also symbol that we are now trying to invest and establish ourselves in a better way.
Johan Torgeby, thank you so much for joining us. He is, of course, the Chief Executive Officer of SEB. Now, Bloomberg Surveillance, the early edition, continues in the next hour. Matt Miller joins me out of Berlin. Kaylee Lyons joins me out of New York. We'll have a full roundup of the earnings. We have, of course, the banks. We have quite a lot of news also in the tech space. We had Alphabet, the parent company of Google, and then later on we have Facebook and Apple. The other thing we're watching, of course, is vaccination across the world. We'll have a full roundup of what that means for markets, and we look at Fed decision day as well. This is Bloomberg.
Focus is odor detection, and this is because no matter how you're bound, what container you're in, you're still producing and releasing odors, and we're kind of building off of wildlife detection dogs.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, they party, makeup will bounce back.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The bottom line is clear. If you're vaccinated, you can do more things more safely.
For vaccinated people, outdoor activities without a mask are safe.
It's very different walking through a hospital now in most parts of the country than it was just a few months ago, and that's because of the vaccine.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Kaylee Lyons.
Well, good morning from London, Berlin, and New York on this Wednesday, April 28th. Our top stories today. The Fed stays the course. Policymakers expected to make no changes to interest rates and the bond buying program. President Biden fills in the details. He'll unveil that giant spending plan and wants to use tax hikes to pay for it. Progressives say he's not going far enough. And Deutsche Bank bounces back. The German lender raises its outlook after the best quarter in 7 years. So let's begin with that breaking news on President Biden's American family plans. Joining us for all of this is our Bloomberg editor-at-large, Marty Schenker. Marty, this is basically almost an add-on to the infrastructure plan over 10 years, 2.25. This is how to make people feel better, and it's an extra 1.8. What are the details?
Well, the details are this is the return of big government in Washington, and sort of it essentially is the end of the Reagan era that dominated Washington politics for almost 40 years. It is a transformative plan that would allow for free childcare, free community college for Americans, a permanent child care credit for lower-income Americans, and it does fulfill a promise that Biden has made that he is going to take care of the least advantaged taxpayers.
One of the interesting things, I think, Marty, is that we don't get a bump up in the estate tax. It doesn't hit more people at lower levels. A couple can pass on $24 million before they're hit with the rates that can climb to 40%. Wouldn't that have been one of the redistributive tools that makes the most sense if you want to raise taxes on the rich?
Yeah, you know, Matt, the estate tax, or what people commonly refer to the death tax, is a very touchy issue for Americans and for Congress. It's clear that Biden's advisors felt that they were doing so much in other areas that doing something on the estate tax itself would just be a step too far. What's interesting, though, that the step-up basis on inherited businesses and investments is in the bill, in the proposal. So that would take care of some of the inheritance tax issues.
Marty, the president is going to try and sell Congress on this package in his address tonight, but he'll also be talking to the American people. Is there popular support behind this kind of spending?
Well, in the briefing that the administration gave us, they claimed that many of these proposals do have popular support, and it is targeted to make sure that people understand that this is an American families plan, not necessarily a tax increase. But the GOP is going to paint this as the beginning of the big spend, big tax era for the Democrats. And the American people are ultimately going to decide which way this counts.
So who supports this change, Marty? Is there anyone from the Republican Party that could actually get behind it?
It doesn't look like it, but, you know, they can put through these tax increases through the Senate with just 50 votes. So Joe Manchin has been very skeptical, so holding that coalition together is not going to be easy. Plus, the state and local tax exemption issue still rides supreme in New York and in California and Illinois, and they're going to have to do something about that.
Previously, economists would have come out with concerns about these kind of tax increases, Reagan-era economists, as you point out, Marty, hurting economic growth. Are we hearing any of that? I haven't seen too much of it.
No, you're not hearing a lot of it, but I think you're going to start hearing a lot about it as this moves its way through Congress. Yeah, the argument is that the U.S. growth rates over the last 4 decades far exceed those of, for instance, Europe, that has many of these programs that Biden is proposing. But there's controversy over whether that's really the root cause of why U.S. growth, economic growth, has outstripped the world.
Marty, you were talking about the lack of a likelihood that any Republican is going to get behind this. Joe Manchin, also a moderate, is a factor here. But what about the progressives? Because they have been pushing for even more spending than this. How could that complicate the negotiations on Capitol Hill? Well,
you know, it's true, Kayleigh, that the progressives, even though Joe Biden is going big, as a Business Week cover said a couple of weeks ago, for some progressives it's not big enough, and that they think that this is the moment to get things like student debt taken care of. But so far the Biden administration has done a pretty good job keeping the progressives in the tent, and we'll see whether or not they go outside the tent as this works its way through Congress.
All right, Marty, thanks very much for joining us this morning. Marty Schenker, Bloomberg editor-at-large, on you know, this is one of the issues that doesn't just drive markets on a day-to-day basis, but a longer term. I'd say one of the twin issues along with Fed policy. And we will have special coverage of President Biden's address to a joint session of Congress later on today. That starts at 8:30 p.m. in New York. It's 1:30 a.m. London, so maybe you'll have to set your DVR for that. Let's get on to bank earnings. Deutsche Bank raised its outlook after achieving the strongest quarter for 7 years. Fixed income trading outperformed Wall Street peers once again, and the bank dodged losses from the collapse of Archegos. Deutsche Bank CFO James Moltke told Bloomberg he expects some of that trading beat to slow down in the current quarter.
We would not expect a similar pace to the first quarter. It's, remember, a very difficult comp for the industry in the second and third quarters, because those were particularly buoyed by the environment that we had last year. Nevertheless, we see a sort of encouraging ongoing activity.
It is pretty amazing that Deutsche Bank continues to outperform its Wall Street peers in terms of fixed income trading, and that Christian Saving did so well compared to his predecessors in terms of earnings this quarter. For more, let's bring in Bloomberg's Danny Berger. Danny?
Matt, yeah, Deutsche Bank definitely not anymore the problem child of European banking. And look, I think kind of what we're witnessing with seeing this stock rise more than 7%, its biggest gain in 5 months, is that unlike a lot of U.S. companies that reported, expectations perhaps weren't as high for the European banking sector. So that gives us a picture when you get these blockbuster earnings from Deutsche Bank, it can indeed move higher. And I want to put that FICC trading in context, Matt, because it is very impressive. A 34% gain. The average gain on Wall Street was just 17%. And sure, Von Monkel there talking about that it's going to be difficult to keep up in the second quarter. But if it's gaining more market share, if it's gaining on its Wall Street peers, that is a promising trend that's going to help the stock move higher. Of course, also helping things out was the fact it was able to dodge any Archegos damage, though I should say a small cost, but definitely a cost in the earnings there associated with the fallout from Greensill. Francine?
Danny, thank you so much. Danny Berger, there was some outstanding reporting also through, of course, all of the Archegos scandal from when it started. Matt, the other story today is Nomura suspending some of the executives and maybe replacing the risk head post Archegos. I have to say, Matt, I was surprised yesterday because we had a story looking at Credit Suisse and UBS also looking at removing some people tied to risk management. And the only thing I could think of is, you know, why would you wait so long to actually look at what happened and kind of, you know, have a change of scenery if they should have done better?
Yeah, well, they're very different cultures, right? Zurich and Tokyo. Credit Suisse, I think, was pretty merciless with getting rid of, firing a number of highly placed individuals, while Nomura has taken its time. It's more under the radar. They've suspended or moved some of the people working in these leadership positions. So I think it may all just come down to a different culture between how the Japanese operate and how the Swiss operate.
Yeah, I think Nomura also lost some $2.9 billion. I think, you know, Credit Suisse is almost double that. Kaylee, apart from the banks, what else are you watching?
Well, Nomura was higher by about 1.5% in the Asian session overnight, really just rallying in tandem with Japanese equities more broadly. The Nikkei closed higher by about 0.2%. And we really saw gains across Asia. The Hang Seng in Hong Kong was higher by about 0.5%, as was the CSI 300 in China. In foreign exchange, I would note one of the big underperformers in the G10 space is actually the Aussie dollar, weaker against the US dollar by about 0.3% after weaker than expected inflation data, indicating that policy normalization there may lag behind even the Fed. I would note, though, that the Indian rupee is stronger against the dollar for a third day, despite the ongoing virus crisis in that country. As for what the picture looks like in Europe, it is a bit mixed. We are just fractionally lower on the stock 600, though we are seeing gains for some of the other indices. The UK FTSE 100, for example, up about 0.2%. Gains for the DAX and the CAC as well. The euro is weaker against the dollar today, sitting at 120.71. And I would note that the rally we've seen in some of the commodity complex, the ags, the industrial metals, is cooling off today, though we are seeing Brent crude just fractionally higher just above $66 a barrel after OPEC Plus said yesterday it is going to go ahead with its plan to slowly increase supply as demand picks up. As for what the picture looks like here in the U.S., it was big tech that was under the most pressure yesterday, and once again, NASDAQ 100 futures pointing lower by about 31 points, down 0.2% after we got mega cap tech results after the bell yesterday. We have more on deck today, but before we get to those tech results, we also have to get through the Fed decision. And ahead of that, yields are moving higher. We're just shy of 1.64% on the 10-year Treasury yield, which is the highest in about 3 weeks. It'll be interesting to see if the Fed even talking about tapering and what they say about inflation. On inflation, I would note the 10-year break-even rate is sitting at 2.41%, which is the highest since going back to 2013. And with that higher yield story this morning, Francine, the dollar is broadly stronger in the G10 space.
Kaylee, thanks so much. A lot to watch out for now. Coming up next on tech earnings, Hussein Kanji, Hoxton Ventures partner. We'll talk, of course, about Alphabet, the Google parent, and the $50 billion buyback. We'll also talk about Facebook and Apple later tonight. Stay with Bloomberg for our coverage of President Biden's address to Congress. That starts at 8:30 p.m. in New York, 1:30 a.m. in London, and this is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London and Matt Miller in Berlin. Well, Francine, Matt, I want to take a look at some of the stocks moving in pre-market trading in the U.S., all of them companies that reported earnings after the bell yesterday. First up, Alphabet, the parent company of Google, up more than 5% in pre-market trading, revenue blowing past analysts' expectations. The story really is, Francine and Matt, that as the economy reopens, businesses are spending a lot more on digital advertising. So that aiding the company, plus a $50 billion share buyback, is boosting the shares this morning. To the downside, though, Microsoft, it did had a record quarter when it came to revenue, beat on earnings for the 9th quarter in a row, yet that was not enough to impress investors. Shows just how high expectations were going into the print. That stock is down by 2% in early hours, and getting absolutely pummeled in pre-market trading is Pinterest. They beat in the first quarter. That's not the issue. The issue was the outlook. User growth, they say, will be about flat in the U.S. in the second quarter as people emerge from the stay-at-home world. They're not going to be signing up for Pinterest as much. It's that pulling forward of demand, a similar story to what we saw with Netflix last week. And as a result, those shares are down by 10.5% before the bell, Francine.
Kaylee, so Alphabet gaining 5.2%. So let's start there with Hussein Kanji, partner at Hoxton Ventures. Hussein, thank you so much for joining us. When you look at what Alphabet did, I mean, 50 billion, first of all, is a huge number. I mean, it's actually the size of, a smaller GDP or, GDP in smaller Eastern European countries. But overall, they lost money also for deliveries in the drone, but also the driverless cars division, I think, not autonomous vehicles. Does that tell us something about the future, or do they just need to spend at the moment to make sure that once it's viable, they're there first?
Well, I think all of their future bets are losing money right now, but that's expected. They're almost like venture capital bets at the moment. So you're waiting for them to invest, and they take a lot of resources, I think. I mean, driverless cars are not a couple of $1 million of investment. They're going to be a couple of billion of investment. They're prepared to do that. We won't really know the answer for that for another 4 or 5 more years, unlike what some of the publications are saying. I don't think driverless cars are around the corner anytime soon. It's going to take quite a bit of time, I think, before they're on the road.
But they have the money to do this, right, Hussein? I mean, this is kind of the point of these moonshot investments. I guess this one is now less of a moonshot than it would have been 5 years ago. They're generating enough from ad revenue to support these kinds of mid to longer term bets.
Exactly. I mean, I think they're playing the role of what's around the corner in the future, and how can we be prepared to write the check? And, these are not the checks that the venture capital community is going to be able to write, because it's just too capital consumptive. So the winner for these kinds of things is going to be one of the bigger companies, which is prepared to write the check and has the resources. So they're diverting the cash flow into these portfolio of more speculative bets, but I don't think they're that speculative, because I do think they're kind of around the corner, and they're prepared to make the investments to see if this could be the next big thing in their kind of portfolio of assets as a holding company. It's a smart strategy, but it's them basically playing venture capitalist.
Hussein, it's interesting. We talk about so many of these tech companies being winners during the pandemic, and the thought has been that they're going to lose as the world reopens, but Alphabet actually benefiting in kind of this convoluted way from the reopening of the economy. How long can that last, and are there any other tech players that can continue to see growth even in a post-pandemic world?
Well, so I think that's the big question. I think everyone's usage numbers are going to come down as kind of the world goes from buying stuff and being in this kind of forum and all online back to kind of doing real experiences. But these are really strong companies at their heart. And so even in the real world economy, I think a lot is actually driven by the online players in terms of just discovery and advertising. So I think they've got some real fundamental strengths behind them on a secular basis, irrespective of the pandemic. The pandemic, I think, just accelerated the consumption because everything was taking place online. So, I think Facebook is in the same spot. I think Amazon's in the same spot. I think Apple's in the same spot. The biggest question mark, again, for someone like Facebook is just what happens with all the privacy and tracking information that Apple is now baking into their products.
Absolutely. It seems to be the biggest concern for Facebook of all of them, Hussein, because, once you start subscribing to paper towels on Amazon, that's pretty sticky. And it looks like we're going to have a hybrid work model going forward. People are going to still need iPads and iMacs. But Facebook is the one thing that doesn't really seem to add any value. You only do it maybe if you're stuck at home because there's literally nothing else to do. Once people are allowed back out into the world, what's to keep them on Facebook?
And you see that, by the way, in the data. So the Facebook consumption, as well as the YouTube consumption during the pandemic, kind of skyrocketed up. But everyone's forecasting that's not going to stay. And Apple devices actually sold quite a bit as people started using them for educational purposes at home. You needed more Macs and more iPads. Those are sluggish businesses before the pandemic, and they kind of accelerated. There's this open question on what you need Facebook for once these privacy controls kind of comes in. I think the Facebook argument is that a lot of shopping is going to take place on Instagram, and they're going to be able to drive commerce, but that is still a yet to be determined. It's an open question, I think, whether they will really suffer from these things, both pandemic as well as privacy, or whether they find a new business that kind of grows them up.
That's all I need, Hussein, even shopping on Instagram. I mean, I didn't find enough ways to spend money. Hussein, when you look at, Apple, so it's also reporting, what are you expecting from them? And can 5G really drive demand for the next cycles of some of the hardware they're selling?
Yeah, so I've been pleasantly surprised by what Apple's been able to do with both the iPads and the Macs, which are sluggish, and then there's a question of the phones. The phone business has come kind of roaring back to life in terms of its upgrade cycle, predominantly based on China. So the Chinese growth has actually been really good for Apple this year. The Chinese economy, unlike other places, is kind of ahead of the curve on the pandemic right now. So life has kind of returned more back to normal over there than anywhere else in the world. And then the question for Apple is just what happens with 5G. And if, replacement cycles used to be about 3 years for the iPhone, they've gone to about 4 years. But I think everyone's expectation is with 5G rolling out in the U.S., people are going to try and upgrade their Apple devices. So they're kind of most analysts are forecasting there's going to be a big upgrade wave for Apple that is going to benefit from later this year.
Yeah. Hussein, thank you so much. I actually have 5G. It doesn't work great at the moment, even in London. Hussein Kanji, partner at Hoxton Ventures, joining us on all of these FANG stocks. Now, coming up on Bloomberg Technology, Brad Smith, Microsoft's president and chief legal officer. You don't want to miss that interview at 5:30 p.m. in New York, 10:30 p.m. in London. And this is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London, Matt Miller in Berlin, Kaylee Lyons in New York. We're actually talking about colors. But on to the Bloomberg First Word News, and there was a tense encounter in the Persian Gulf between the U.S. Navy and Iran. The Navy says an American warship fired warning shots when Iranian Revolutionary Guard vessels got within 68 yards of the ship. Now, the Navy released black and white video of the incident. Saudi Arabia is in talks to sell a 1% stake in Saudi Aramco. Now, the sale could be worth about $19 billion. According to Crown Prince Mohammed bin Salman, the kingdom is looking at a deal as a way to lock in a customer demand for the country's oil.
There's going to be something very soon. There may be a sale to key main investors that will be announced in the next 1 or 2 years. I don't want to give any promises about deals finalizing, but there are discussions happening right now about a 1% acquisition by one of the leading energy companies in the world. This deal could be very important in strengthening Aramco's sales in a country where this company resides.
China is the largest buyer of Saudi Arabian oil, and Walmart's fight against the $15 minimum wage is putting it in the inequality spotlight. Rivals such as Amazon, Target, and Best Buy all pay at least $15. While Walmart is the nation's largest employer, its resistance risks pulling attention away from its improved pay, plus education and maternity leave benefits. In February, the retailer said it would raise the average wage paid to its associates, but not to the minimum, to more than $15. And I couldn't believe when we were talking about the story, Kaylee and Matt, 1.5 million people are employed by Walmart. Coming up, it's Fed Day. We'll look at rates. This is Bloomberg.
Renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and deaths. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Wednesday, the Fed decides. The Fed is on hold waiting on inflation. But for how long? Coverage begins 2 p.m. on Bloomberg Television.
This is Bloomberg Surveillance Early Edition. I'm Francine Lachman in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, Matt, we're also watching the Fed, but of course this kind of pales into comparison to what we heard from President Biden and of course his Families Act plan.
Yeah, absolutely. I mean, the Fed, you said it yourself at the top, not expected to really do much. And it's unlikely that we're also going to get very many signals as to when they will do too much or even talk about doing more. So the tax plan, I think, is key for investors right now. You're going to see capital gains tax, the money you make from investments, double if you make more than $1 million a year in your household. That's huge.
Yeah, it's huge, and of course that could move treasuries, which would then have an impact on the funding and what the Fed could do. So it's all linked. Kaylee, what are you seeing on the markets?
Well, there's so much going on. We have Biden's address to Congress, we have that Fed decision, and also we have results after the bell from two of the mega cap technology companies, Facebook and Apple. It is so much for the market to digest on a Wednesday. Where that leaves us at this point in the European session is just fractionally lower on the stock 600, down just about 0.1%. Here in the U.S., big tech continues to lag, but we are seeing S&P 500 futures just higher by 1 point. They've been fluctuating a bit between gains and losses. Ahead of that Fed decision, the 10-year yield is up 2 basis points, sitting at 1.64%. That's the highest in about 3 weeks, and that move higher in yields has the dollar stronger on the day. Now, of course, as I mentioned, it is also earnings season. We have a number of stocks moving on the back of the results they reported last night in pre-market trading. Advanced Micro Devices is higher by a little more than 4%. They beat in the first quarter, but it really was the fact that they raised their full-year outlook that is aiding sentiment this morning. Visa is also higher by about 1%. It saw debit volumes up 31% in the U.S. in the first quarter as all those stimulus checks hit Americans' bank accounts. The company is saying they see the beginning of the end of those pandemic spending woes. You do have Starbucks moving to the downside, though. Global comp sales missing estimates coming in at 15%. The street was looking for 17% growth, so those shares are lower by about 1.5%. And then Facebook, it has not reported yet. That's due after the bell. But Google and Alphabet in its report after the bell last night underscored the strength in digital advertising that the company is seeing as we emerge from the stay-at-home world. So that is giving a little bit of a lift to Facebook shares ahead of its results, higher by the better part of 2% in early hours, Matt.
All right, very interesting to see Starbucks. You know, I thought that was pretty interesting that people aren't coming out, at least they aren't coming out and then going into a Starbucks as much as you may have thought. And of course, as we were talking about earlier, it's going to be fascinating to see if people stay on Facebook as they go out and don't go back into a Starbucks. I wanted to, have I given Hillary Clark a shout out lately? I don't think I have in the past couple of
Never
days.
enough.
Our charts queen put this beauty together for me from Goldman Sachs data, and I think it's just fascinating. For those listening on radio, this is a chart that goes down and to the right, but that indicates easier financial conditions than we have ever had. Goldman Sachs says financial conditions are the best that they've ever been on record, Fran, which is why I think it's going to be difficult for the Fed to get more dovish than they already are today.
Yeah, and I think the markets will keep on pushing for some kind of timeline on when at least they start talking about tapering. So the Fed is all but certain to hold steady today as officials assess the accelerating recovery. Billionaire bond king Jeff Gundlach says the Fed is guessing when it comes to its view on inflation.
We don't know. Nobody knows. Most concerned about the fact that the Fed thinks they know. There's plenty of indicators that suggest that inflation is going to go higher and not just on a transitory basis for a couple of months. So we'll see. That's how I think the Fed is trying to paint the picture, but they don't really, they're guessing.
Okay, they're guessing. Nobody knows. We hope Ralph Preuser knows. He's a global head of rates research at Bank of America Global Research. Ralph, as always, thank you so much for joining us. Before we get on to Fed specific, if we put the funding into context, so with this additional Families Act plan from President Biden, it's $2.2 trillion on the infrastructure plan over 10 years. This is an extra 1.8. Is it okay when Treasury yields, you know, the 10-year yield is at 1.6? But is it not okay at 2.5? And actually, is that the level cutting off point that we should be watching out for how acceptable it is that yields rise?
Lots of difficult questions all wrapped into one. So first of all, higher supply should support higher rates, right? But as you pointed out, at some point this will become self-defeating because there will be a concern that the amount of funding that needs to be spent will ultimately require lower rates to be sustainable, as well as there will be questions of the extent to which higher rates will ultimately undermine other asset classes, be it credit or equities. The way we've been looking at it is to say that rates can easily go towards 2.25 by year end, but after that things should get stickier, and not so much because we're worried about how much debt there is to fund and what level of rates you need to fund that, but rather because at those levels of rates we expect to see demand crystallize, primarily from two sources. One, from global fixed income portfolios, because at that point US rates will start looking very attractive on a cross-market perspective, as well as within a global asset allocation process, because at that point fixed income will also look attractive relative to equity markets and will start to look very attractive as hedges to equity markets.
Ralph, give us a sense of actually, what the conditions are that you see for the Fed to start tapering, because they probably don't want to say it, but this is what the market wants to know.
I think we're a long way away from tapering itself. I think the interesting question is what are the conditions that the Fed needs to see to start talking about tapering, and how long does it take to get us there? And I think that is something that we can expect to see in the next few months. It's probably too early for today, but we would be very surprised if that debate doesn't intensify over the course of the summer, so maybe as early as the June meeting. And definitely we would expect a lot more detailed discussions about it around Jackson Hole and the September meeting.
How important is the commodities rally, Ralph? Goldman Sachs and UBS both saying that this hot run isn't even close to done. Goldman Sachs saying raw materials are going to surge 13.5% in the next 6 months. These input costs must be, if not difficult, at least notable for manufacturers.
Sure, but I think that is the interesting bit of the inflation debate, right? We know we are going to get very supportive elements for inflation coming through from commodity prices in particular, and the oil price base effects from last year, which will result in some fairly dramatic headline prints in the US over the course of the summer. But to your point, the big question is how much of those price increases can actually be passed on to consumers, and how much of it will just translate into margin compression. And the hope, obviously, is that with the amount of demand stimulus that we're getting in the US, pricing power will be relatively healthy, and at least there will be some element of pass-through, which will help to get inflation, more sustainably towards target. But that's not necessarily the case elsewhere, and obviously the extent to which we are dependent on these commodity imports also varies significantly across countries. But I guess that's the interesting part of the inflation debate. For now, we are reasonably relaxed about it.
Well, Ralph, we've already had a number of consumer goods companies here in the U.S. in their earnings reports say they are going to raise prices due to those higher input costs. So the translation into CPI is interesting there. And of course, CPI is one of the data points where we saw an upside surprise over the last month or so. And yet we haven't seen the corresponding move in yields that we'd think we would, in that they haven't really moved materially higher. Does GDP tomorrow change that?
Possibly, but I think the key bit to remember when it comes to the translation of CPI into rates is it's via break-evens, right? And we have seen a very dramatic adjustment in break-evens already. Pretty much every forward point on the break-even curve is pricing in, the Fed meeting its target. The question is, at what point is the market going to be comfortable to price in that overshoot that the Fed is promising us? And in which part of the curve will we see that? We do think that we ultimately need to price that overshoot, in particular in those, between years 2 and 5 or 3 and 6, because that is where that overshoot is most likely. But ultimately, we probably need to get past the hump on those base effects and see that sustained increase in inflation for that second leg of the break-even repricing to come through.
Ralph, thanks so much. Ralph Preuser there, Global Head of Rates Research at Bank of America Global Research. Now, stay with Bloomberg for our coverage, special coverage of the Fed rate decision and news conference by Chair Jay Powell. That starts at 2 p.m. in New York, at 7 p.m. in London. Of course, the markets will look at that, and they'll also look at what Joe Biden has to say. We've had details in the last 39 minutes. Up next, EU lawmakers marking the final step in the years-long Brexit drama. We'll discuss what that means ahead with Thomas Byrne, Ireland Minister of State for European Affairs. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day. This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
This is Bloomberg Surveillance, the early edition. I'm Francine Lachman in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, EU lawmakers have now given approval to the post-Brexit trade deal with the UK. It marks the final step in the ratification process and ends 4 years of fraught negotiations. The agreement excludes services, which accounts for about 80% of the UK economy, and the implementation of the deal in Northern Ireland is a key point of contention. Well, we're delighted to be joined today by Thomas Byrne. He's the Irish Minister of State for European Affairs. Minister, thank you so much for joining us. We have a number of questions to ask you, including the Northern Ireland Protocol, some of, the riots that you've seen, and also some of the concerns going forward with vaccinations. But if we start with Northern Ireland Protocol, will this be a point of contention for the next 3, 4, 5 years, or are you expecting the situation to settle?
Well, I certainly hope that it settles, because I think that the big problem with Northern Ireland, apart from all of the other issues that we're aware of, is the lack of certainty over the last few months in particular. I think now that the Trade and Cooperation Agreement is now finally ratified in the European Parliament, that's put to bed as such, it gives certainty to that process at least. I think we will work on focusing on giving Northern Ireland certainty that it needs. The certainty is there in the protocol to the withdrawal agreement that Britain signed up to. And I think we're determined with the European Union, and I would say with the British government too, to ensure that that is operated and put in force in the most efficient and most effective way, and to be fair to every part of the Northern Ireland community, while also, of course, protecting the single market, which is so vital to our members of the European Union.
But, Minister, what exactly does this mean? I mean, concretely, have you had assurance from the UK Prime Minister that this will be dealt with? Have you had assurance from the EU that this will be dealt with?
Well, what's happening at the moment is that there are discussions going on between the EU and the UK about implementing the protocol. So the protocol to the withdrawal agreement is agreed, it's in place, and everybody has agreed that it will remain in place in accordance with the terms of it. What's happening at the moment is operationalising it has always been difficult. And I think the EU and the UK are both engaged in a good faith way to make sure that it's operationalised properly. And there's work going on at a technical level, there's work going on then at a political level as well. But I think everybody's united in a desire to bring certainty to the situation in Northern Ireland and to protect the gains of the peace process and to protect the open single market as well.
Have you had any serious security concerns? I mean, has there been a point when you've started to truly worry about the peace?
Well, we're always worried about it. Michel Barnier at the last meeting of the General Affairs Council of the European Union said the peace was fragile. I thought that was a really good word to use, but how right he was. Because over the last number of weeks, we've seen riots, we've seen some violence, we've seen police officers injured and attempted murder on one particular police officer. And so the situation is fragile and delicate. And I think it's not all related to Brexit, make no mistake about that. But I think the uncertainty there in relation to the implementation of the operationalising of the protocol has certainly contributed to the difficulties there. So I think we need political leadership in Northern Ireland to give leadership there to every community, and many are trying to do that. But also between the EU and the UK, we need to see movement on implementing the protocol. That is starting to happen. I acknowledge that, particularly on the UK side, where we were complaining of at various points in the recent past, but that has changed. I think needs to change as well for the sake of the political and social situation in Northern Ireland. But make no mistake, there are so many other issues there as well, including severe economic deprivation. And I think it's about time that leaders try to show the benefits of Northern Ireland for inward investment, particularly its place in the single market, but also retaining its place in the customs territory of Britain, gives it a unique vantage point for both the British market and the European market as well. And I think if we start to see those benefits accrue to Northern Ireland and political leaders encouraging business to see those benefits and to use those benefits, I think then we would see more stability in Northern Ireland, more economic progress, and indeed more social progress, and all of those are badly needed at the moment.
Can I ask about, Irish sovereignty within the EU? When I see Brussels trying to impose a universal tax regime on all of the different states in the EU, I wonder if it kills competition. Isn't it good to be able to attract different businesses to your shores with your own sovereign tax policy?
Absolutely, and that's been a cornerstone of Irish industrial policy over the last many decades. And it's not simply an ideological view in relation to low tax, that this is why we ideologically believe companies have low tax. It's not that at all. It's a way of attracting good quality companies into our country, to have our educated workforce there to attract those companies in as well, and to give them jobs, to keep people on the land. We don't have a huge amount of natural resources, but what we haven't got in natural resources, we've made up for in the educated resources of our workforce and our society, which are really attractive to companies. And obviously taxes is a key part of that, and will remain a key part of that. But there's so many other attractions of Ireland at the moment for inward investment, and we're certainly in the market for that. The truth is that Irish sovereignty as a small country, I think is brought into effect really by being at that European table and sharing sovereignty in many key day-to-day areas, but retaining our national sovereignty on those important issues such as tax. Having said that, we're very much working as part of the OECD at a global level, so clearly there's a lot of work going on in relation to that, and we continue to work with that, but we certainly have to protect our interests, our economic progress. And we've seen benefits. I mean, sometimes companies have come to Ireland for the tax, but stayed for pretty substantial developments in terms of manufacturing facilities, in terms of research and development, and we see that more and more.
Thank you so much, Thomas Byrne, there, the Irish Minister of State for European Affairs. Now, coming up, Deutsche Bank sees its best quarter in 7 years. Part of our interview with the Deutsche Bank Chief Financial Officer, James von Moltke, is up next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It was a very successful quarter across the board for the company. So the profits were the highest in 7 years, at $1 billion after tax. And frankly, all four businesses performed well in their environment. Of course, it was an outsized performance for the investment bank, as you've seen for us and our peers, with over 30% year-on-year increase in revenues. Strategically, really no change. We're executing on our strategy. We have been in the process of, in a sense, strengthening the franchise quarter after quarter, getting better and better client engagement, and frankly, executing on the strategies that Mark Fedorcik and Ram Nayak set out, I think, very clearly at our Investor Day in December. We're seeing the implications of that, but it doesn't represent a change in strategy, rather a strong execution of that strategy in favorable market conditions.
Well, that was the Deutsche Bank CFO, Chief Financial Officer, James von Moltke, speaking with Bloomberg after Germany's largest bank raised its outlook and reported its best quarter in 7 years earlier today. Now let's get straight to Tom Keene, co-anchor of Bloomberg Surveillance. We used to speak about Deutsche Bank for like hours on end when we co-anchored together. I know you're focused on the Fed ahead of your special show, Tom, but also looking at banks. And actually, for the moment, this earnings crop seems to be significantly better than what we had in the past.
It's significantly better, and what's important there is the margins that we're seeing across sectors. Certainly you saw it with Google yesterday, just extraordinary results, way above. I know Citigroup was a bit cautious, and they noted that Google came in way above street expectations. We go to Apple after the Fed meeting today, and a lot of excitement about what they'll do. And Francine, I think one of the wild cards here globally, and something that Chairman Powell has to take in, is Asia's doing pretty darn good.
Yeah. The other thing, Tom, so if you look at the Fed, right, it's all about guidance that markets hope to know about what needs to happen for them to at least start talking about tapering. Are we, how far ahead is this?
Miles away. Let's look at a chart which shows the foot on the 2-year yield. There's no question about it. They have stayed where they are, and there's every indication, Francine, they will stay there. What does it take to move? Down they go. The pandemic comes in. The 2-year yield crashes down near zero, and it's been level. Francine, there's real no indication that they'll turn this around. They need the number one thing I'd look at, Francine, is wage growth. It's not there yet.
Yeah, it's absolutely not there yet, but it's something that I don't know whether it changes with what, but Joe Biden's announced. I mean, this is pretty significant, and it goes to the some of the things that we call here succession laws.
Well, I don't know what the British process is on this. I defer to you and John Farrell on that. What I would say is he's going to run into a maelstrom of analysis and critique on both sides of the aisle in the legislative branch. It's an executive moment tonight. David Weston leading our coverage, but Francine, I'll tell you, the executive branch turns to the legislative branch to dispose. Who knows what that will be?
Yeah, interesting. I'm looking forward to all of that coverage. Tom Keene, co-anchor of Bloomberg Surveillance. Now, this is what else we're watching for the rest of the day. As Tom was saying, it's a lot about earnings with Apple and Facebook, Kaylee.
Yep, more mega caps reporting after the bell, Francine. With Facebook, I'm watching specifically advertising revenue. Do they benefit from that boost in digital ad spending we saw evident in Alphabet's earnings? Also, user growth. Will it slow as we emerge from the post-pandemic world like we saw with Facebook? For Apple, I'm watching Mac sales, iPhone sales, anything they say about the global semiconductor shortage. But really what's going to be interesting is if Apple beats, do they get rewarded for it? Because, Matt, this stock trades at a forward PE multiple north of 30, which really just underscores how high expectations are, Matt.
Yeah, that's going to be fascinating, and I will be watching that too. But in a broader sense, I'm watching to see if there's going to be any pushback from, you know, Nobel-type economists on Biden's tax plan. It seems like we're all out of freshwater economists. If you look at the most influential economists today, you come up with all these saltwater names: Krugman, Stiglitz, Piketty, Summers, Sachs. There just isn't anyone out there with the clout to push back, Fran.
Yeah, I'm watching the Fed. Look, we have a special show around it. We were talking about it with Tom Keene, and we're expecting for them to talk about this accelerated momentum in the economy without giving the clues to markets about what it would take for them to start talking about tapering. Coming up in the next hour, all of that will be discussed with David Balin, Citi Global Wealth Chief Investment Officer and Global Head of Investments. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
This economic data is great. This is all reopening, fiscal stimulus. Well, how much does behavior change? We're all becoming behavioral scientists.
As things normalize, you're going to see a shift back towards services, and that means taking some of the pressure off the goods sector.
Ultimately, what we have to figure out here is, are we heading into a period of peak data? And peak data historically has been met with corrections.
All eyes really are on what constitutes substantial progress right now.
The good news is, long-term, big picture, the Fed has a long track record of controlling inflation, but it could come at a cost.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is the busiest day of the week from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Bramvitz. I'm Jonathan Ferro. Equity futures positive by almost 0.1%. A Chairman Powell news conference later in Washington, a presidential address, and Tom Keene, a ton of earnings in between.
Yeah, wrapped around it in between, starting here really in 1 hour. We're going to see a lot more earnings, John. I'll give you one idea, John. Apple has gone from 26 gazillion shares to 16 gajillion shares over 8 years. They have retired 38% of their stock in, let's call it, a decade. Why is that going to stop? And that's one of the major thrusts of big tech. Witness the Alphabet share buyback yesterday.
Alphabet, $50 billion buyback, Tom. Yeah. Absolutely remarkable. But when we talk about Google, can we talk about the quietest 30% rally year to date that's come from that company in this stock market? You know, unreal.
You read my mind, folks. We don't talk to each other before the shows. Lisa and I, sometimes, commiserate about children. Pharaoh and I were not on speaking terms, so it really works. And John, what I would suggest is you and I are on the same page. First thing I looked at is year-to-date returns for these equity markets, and they haven't gotten enough love so far. People don't realize it's a double-digit 2021.
Nobody thinks it's a shock that you and I don't talk. Lisa, you and I do talk, so let's talk about Google. This is a clean reopening story. I say clean because this is not 3M. 3M yesterday, the industrial, the manufacturer here in America,
nice
talking about what? Transport costs, raw material costs. Google's not talking about that. Alphabet and the ad business has got great exposure to reopening in America without the worries about costs. And you saw that yesterday.
And that, to me, is the biggest idea here, the idea that big tech also is exposed to the cyclical trade, in particular with respect to increased ad spending, as well as leverage to the tech world, which is going to only continue to get dominant as people move to a work-from-home environment. We are seeing that stick with a number of banks, even as people start to get back to the office.
Got to do a couple of things this morning. Got to head down to Washington, D.C. and get an update on the president's $1.8 trillion family aid plan. We'll do that a little bit later in the program. Here's the price action to kick things off for you. Equity futures on the S&P 500 look like this. On the S&P, in and around all-time highs, up 3. We advance almost 0.1%. In the bond market, did you see the sell-off yesterday? Just picking up a little bit in treasuries. Yields higher, back through 160. Yields up 2 basis points on a 10-year, Tom, to 164.13. And in foreign exchange, shorter 121, euro dollar 120.69, and down 0.2%, going into a Fed decision, Lisa, and Chairman Powell news conference.
Yeah, the 7-year auction yesterday proved yet again to be a bit of a hiccup for the bond market. At least that's what we're seeing today. What you're talking about, John, 2 p.m., that's when we get the FOMC, the Fed rate decision. 2:30 p.m., Jay Powell will be giving a press conference. Substantial further progress. What does that mean? Not only what does transitory, will they double down on this idea of transitory and give a sense of what they're looking for in inflation, but what is the measure of progress in the labor market? Then after market, you were mentioning, John, Apple and Facebook. We're going to get both of those earnings. Apple, expect a lot of discussion about supply chain kinks, also looking for a pretty massive earnings after their announcement yesterday that was trying to get ahead of any potential ramifications on the tax or on the regulation side. Facebook, very interesting to see whether they'll enjoy the same kind of boom that we saw from Alphabet in terms of revenue from advertising. And then 9 p.m. is that American Families Plan announcement from Joe Biden. We've gotten a look at the $1.8 trillion proposal, $800 billion of tax cuts and credits, $1 trillion of spending. This comes in addition to the $2.3 trillion infrastructure spending plan, on top of the $1.9 trillion plan that he passed in the beginning of the year. John, I can't keep track of all of these proposals, and what I am wrapping my head around this morning is what's realistic? What has enough support, both within the Democratic Party and possibly on the fringes, to actually get through?
It is the race to get some big things done down in Washington, D.C., a key part of programming through the morning on Bloomberg TV and on Bloomberg Radio. I want to touch base on just the stock move this morning in the pre-market. It's Alphabet absolutely flying, Tom, off the back of those better earnings, and absolutely flying also off the back of a $50 billion additional buyback plan, and you're seeing that again this morning from various companies.
That's a media favorite and all that. Microsoft, let's remember, didn't do all that shabby, not as well as Google, but I would go to something you can drop in your foot. Good morning, Dennis Gartman, and that is Stanley Black & Decker. John, I don't know if you're familiar with their American heritage, but you mentioned 3M yesterday, and they're raising their organic revenue growth. They see organic revenue growth. John, 11 to 13%
Wow.
for the entire year. This is a company that makes drills.
Oh, I'm familiar with the heritage. I'm just not sure you're familiar with the products. You ever used one of them, Tom?
Yeah, I'm like, can you come up and fix this?
Yeah,
like,
something like that.
I've
got the equipment.
He's got one in the closet.
I bought some Stanley Decker
I think the surveillance nap
That
is done
sounds about
about
right,
3
Tom.
p.m. Could I see you like at 3:30? Thank you.
Yes, I imagine that's how it plays out in a
Yes,
Keene
got
household.
that right.
We are both familiar with the heritage. We are both unfamiliar with the products. David Balin joining us now, Citi Global Wealth Chief Investment Officer and Global Head of Investments. David, let's just talk about, I think, the key discussion right now, the best way, the cleanest way to get exposure, durable exposure to a better American economy.
Well, first of all, I want to be Tom's repairman, but other than that, I really want to say that this is a pretty extraordinary time, and you've actually hit upon a couple of those themes. Number one is incredible revenue growth for technology companies, and the benefit, of course, to their stocks. But that's what's benefiting the economy: this incredible efficiency and incredible flexibility of companies, global companies and U.S. companies. Number two is, and you use the great example of Stanley Works, the idea of what growth is to come. When we talk about an economy growing 6 to 8% after a pandemic, there are two aspects to it. One is the actually ability to spend, right? And that ability to spend is due to household savings, and that ability to spend is actually due to the fact that people have not had the opportunity to leave their home to do things, to begin doing work for themselves, right? And what we're seeing is a pent-up demand from the consumer, as well as, right, an enormous amount of stimulus, and as well as the fact that people are going to begin to act as they did, a year and a half ago. All of that is happening at the same time. You've asked another question, I think, in your programs, yesterday, which is what's sustainable, and that will be very interesting. Lisa talked about this in the intro just now, which is, some companies are going to be able to keep this boost of revenue. Like a company like UPS reporting extraordinary, shipments and things like that. To the extent that people continue to work from home, that will continue to take place. And so this change of behavior that's definitely going to be underway for the next couple of years, companies that have challenged it, that's going to be a big deal. The more people are adapting to work in the future based upon what they learned in the pandemic, the more we have this sustainable revenue growth that you're seeing now.
Hey, David, the big fear out there, I want you to address this, and we see this along the way for different reasons, but now front and center is margin compression. OMG, units, price, revenue, down we go. And on the income statement, we're going to see some forms of margin compression. I don't see it.
Well, I do see it, and I think you're going to see it on a temporary basis as certain things are really in short supply. When the economy reopens, the other thing is we're going to have all of the inputs, except for labor. All of the inputs are going to go up a great deal in terms of their cost, right? All of the commodities, the cost of actually shipping goods and services, the fact that there is going to be, the way I put it, 16 months of inventory needs to be produced in 12 months to not only satisfy current demand, but to refill the supply pipeline. All of that's going to take place now, and that will cause some delays, and it also will cause prices to go up. I also believe, however, that this will be passed through to the consumer because the leaders are going to not see margin compression. Now that brings up the idea of inflation. People talk about it, and there will be, I think, temporary inflation for the course of the next 12 to 18 months. We want our clients to own tips right now. And the only thing we really love in the fixed income market, other than high yield, are tips because they actually will capture this type of consumer inflation. But it won't be forever. It'll just be for this particular boost of time.
Well, and the temporary inflation boost hinges on the idea that we're not going to get a material shift in the economy. And here you had Google yesterday announcing a $50 billion share buyback. Is that good or bad for you as an investor after all of these investors said they wanted to see investment in the infrastructure of companies, the investment in actual productivity going forward? Share buybacks doesn't get that done.
Well, they really don't have much of a choice. When you're just handed, literally boatloads of cash because of the fact that your investment is in human capital. If you think about it, that is, they have excess cash, they're doing buybacks. Who else does it benefit? Well, it benefits all of their employees as well. They simply don't have the internal research and development costs that are required, necessary to sustain the growth that they have. It's not going to be building new manufacturing plants. It's just going to be hiring new human capital. And they will do that And that's why they're going to benefit both their shareholders and their employees by doing so.
David, always good to catch up with you, sir. Great to catch up on this market, too. David Balin, Citi Global Wealth CIO and Global Head of Investments. A little bit later, Apple coming up a little bit later after the closing bell, following what we heard from Microsoft and Alphabet yesterday. Then tomorrow, Tom, it's the next big one, too. It's Amazon on deck.
Yeah, beneath the radar is the rumors on Apple. I'm not even sure if this is out in the zeitgeist. Yes, the leadership here, of course, is from our wonderful Mark Gurman, who's front and center. But the M1 chip, John, they're already modeling out a press release of the next chip. I mean, Apple's looking beyond with all the investment in North Carolina and that to the M1X or the M2 chip, which is substantially fancier. Maybe we'll hear about that today.
And Tom, you started this. Do you know how many messages I've had over the last couple of days about a potential stock split over at Amazon
come on. I just
tomorrow?
Was, you know,
I know it's what you want.
Why do we have a
I know it's what you want.
No, I don't care. Come on, I don't have an axe in this. John,
you
explain to me. No, I don't. Explain to me why we have a $3,000 stock price. I mean, it's not Warren Buffett out in Omaha. This is part of the American fabric. They ought to bring the thing down to a Dow equivalency so they can join the index that matters.
It's 2021. You don't know to be in the Dow. Let's be clear about that, one. And two, there is such thing as fractional share ownership as well, Tom.
There is.
Do you really need a stock split in 2021?
If you want to be in the Dow, 33,834, Amazon should be in the Dow.
Amazon should be in the Dow. Okay. I'm not going to bite back. I'm not doing that this morning. We're too busy. Need too much energy for later on today, Tom. I'm not going to bite back on the Dow. I'm just not going to do it.
Jerome Powell quotes the Dow.
Chairman Powell quotes the Dow, does he?
Yep.
Oh, my God.
When they look at financial conditions, do they look at the Dow?
No, they do not. They look SPX.
John, how long has this Dow argument been going on between you and Tom?
I don't know.
No, this goes back to my mother. My mother used to sit there with a martini in her hand, screaming about the Dow at 300.
Let me tell you about my mother. Next block.
Come on, the Dow.
John.
Coming up,
matters, John.
7 a.m. Julian Emanuel of BTIG.
Cambridge Associates uses
There's
SPX.
so much
Julian
going on,
Emanuel
TK.
uses SPX.
Got a $1.8 trillion family aid plan down in D.C. Got no interest in arguing about the Dow this morning. Here we go. The market that matters. S&P 500 futures up 3.
Oh,
we
no.
Almost a
John
tenth of
Farrow
1%.
faces formal probe over apartment refurbishment.
Okay, we can talk about that in just a moment. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Tonight, President Biden will unveil a $1.8 trillion plan to expand educational opportunities and childcare for families. It will be paid for in part by the largest tax hikes on wealthy Americans in decades. Amongst the legislation's provisions, pre-kindergarten and community college would be free, and the child tax credit would be extended. Meanwhile, fund managers would lose their carried interest tax provision, and the top tax rate for individuals would go back to 39.6%. Fed Chair Jerome Powell is expected to maintain aggressive support for the economy. Fed policymakers wrap up a two-day meeting today. They're all but certain to hold interest rates near zero. They're also expected to repeat a pledge to keep buying bonds at the current rate of $120 billion a month. And a grim milestone for India. The number of deaths from coronavirus went over 200,000, a 52% increase in infections that outweighed declines in most other regions. New global cases of coronavirus rose for the 9th straight week by a record 5.7 million. Deutsche Bank has posted its strongest quarter in 7 years, and it's raised its outlook. Fixed income traders outperformed most of their peers on Wall Street. Income from buying and selling debt securities rose 34%, and Deutsche Bank avoided loss from the collapse of the Archegos capital management. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, they party, makeup will bounce back.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
If you go up to 40% capital gains tax, that's a really big problem, and that's a huge headwind for the U.S. stock market. Another huge headwind, of course, would be the wealth taxes that we're talking about. Those seem much less likely to pass to me, but those would be other issues that would greatly discourage small business investment.
Well, Jeffrey Gunlack there, the Double Iron Capital CEO and CIO. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Wednesday morning. Ahead of the Fed and ahead of an address from the President of the United States. S&P 500 futures slightly positive, up, let's call it 2 on the S&P 500 to 41.81. In the FX market, euro dollar stable, negative by about 0.2%, 120.69. And yields have been creeping higher in the last 24 hours. That continues today, up another couple of basis points to 164.13. Tom Keene bringing up apartment refurbishment. So let's talk about one that took place at Downing Street. It's unclear how that refurbishment of that particular apartment, that flat of the Prime Minister's, was refurbished and who funded it. The UK and the Prime Minister facing a formal probe over his apartment refurbishment. That is what you were alluding to, Tom, a couple of minutes ago on this program.
Ancient American tradition, Mary Todd Lincoln really having it out over what she spent. The president, this is a few years ago, John, really having to work on that. What I would note, John, is our good friend George Osborne probably was called in because he's from the family of Osborne and Little, and you gotta know that Boris picked that fabric to get it done.
I'm not in a position to confirm that this morning, Tom, and I think it's probably a conversation you and I should have offline.
John,
and not here.
10 Downing Street, it's got to look nice, right?
I agree that it's got to look nice, but it depends where the money comes from.
Okay,
and if it comes from a party donor, you might get in a little bit of trouble.
I would have done it in Tots Blue.
You would have done it in Tots Blue?
Yes.
I thought it was Tots White.
Actually, Chelsea Blue would be a bigger statement now.
Chelsea Blue. Okay.
Yes.
Should we move on from that?
Continue.
Such a quiet morning, isn't it?
It is a quiet morning.
So
Let's go to the
quiet.
speech tonight. David Weston leading our coverage tonight. Look for that on the president's speech. Benjamin Bain joins us now. Ben Bain of Bloomberg News, thrilled he could be with us as well. Ben, I read Nancy Cook's article very, very carefully. Is this thing dead on arrival, or will there be subject to amendment in the coming months?
I don't think it's dead on arrival. This is going to be the centerpiece of a lot of back and forth here in D.C. over the coming months. Certainly, everything that's in this this plan that we're going to hear about tonight is quite unlikely to actually make it over the finish line. But this is kind of the opening salvo here, right? I mean, and what you're going to hear from the president, I think, is a lot of things that Americans watching tonight probably sounds pretty good to them. You're going to hear about free pre-K. You're going to hear about more money for, be able to go to community colleges for free. You're going to hear a lot of things that he talked about during the campaign, and a lot of Americans probably would like. So I think, what he's going to do tonight is he's going to sell this not to the 200 members. There's going to be less people than normal because of the pandemic in this chamber, but he's going to be, trying to sell it to the American public, and some of the stuff is probably popular.
Okay, this is great. It's Washington talk, John. McConnell in Kentucky calls this a liberal wish list.
Called it a bait and switch, Tom. Called it more than that. And Ben, I think it's hard to call it a bait and switch when so much of this was talked about on the campaign trail. What is in this that's surprising to you?
Yeah, I mean, look, these are things that he did talk about at the campaign trail. I think, though, there is some surprise here just how much, the president is going forward with some of the things that the progressive side of his party have wanted for a long time. I think there was, some thought going in that we weren't really sure where President Biden was going to lead from. He's always talked about trying to be that deal maker. You look at his time in the Senate, that's where he was. What we're seeing here is a lot of things that progressives have wanted for a long time. So it's not a surprise because he talked about during the campaign trail, but he's actually coming through with a lot of things, not all of them. Some things are left out of there, but for the left side of the Democratic Party.
Ben, what's the strategic logic in introducing this $1.8 trillion bill right after the $2.3 trillion proposal for infrastructure spending that's still very much not off the ground?
Yeah, I mean, I think that's kind of the open question here. I mean, you can look at it on one hand and you're like, this is a little bit like kind of flooding the zone here, right? I mean, everything is coming out. I think you mentioned earlier that it's a little bit even hard to keep track of all these proposals that are out there. This is now the third big trillion-plus plan. One of them's gone through that the president and the White House have put forward. I think what they're trying to do is basically put everything out there and kind of probably see what they can get. I think we're going to see a lot of back and forth here.
They put the estate tax out, and I believe that was jettisoned in the last 48 hours. What's the next tax lift to be jettisoned?
Well, I mean, so there's a few things in here that Republicans are certainly unhappy about. One thing I'm particularly paying close attention to in here is this carried interest provision. If you remember back to 2017 and the fight with Trump's tax cuts, that was a big win for private equity. They were able to keep that in there. They hold these investments for 3+ years, and that is a really, 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 really important thing for the industry. And there's going to be a big fight in Washington over that.
Ben, let's talk about that fight just to wrap things up. I've heard a lot of people talk about the biggest changes since the Reagan administration. If anyone wants to bring up the 1984 Electoral College map and have a look at what the mandate looked like for Reagan, it's very different to what the mandate looks like for this administration. How important is that?
Well, I think it's very important, and we're also in a situation here in Washington in general right now where the electoral campaigns don't start 6 months before an election. I mean, people are talking about 2022 already. So there is a window here. And back to your earlier question about why all these proposals are coming out right now, I think there's a realization that if they're going to get something done, we're coming up on 100 days here. There's a limited window here for this administration to really go after the big priorities. And that seems to be what they're doing. And they're hitting them one by one. And I suspect this is not going to be the last one we see.
Ben, great to catch up. Ben Bain down in D.C.,
Thanks.
Bloomberg's very own. Tom, elections have consequences. How many times have we heard that over the years, over the decades, over the centuries? And they do. And that election, that runoff in Georgia, those runoffs have had huge consequences.
Yeah, get out the calendar. Yeah, the elections have made this strategy that we see. But I would look forward, John, in that it's May, and pretty soon it's going to be August, and pretty soon the primary season is removed. But by spring of next year, this tax history of 2021 will be part of the electoral dialogue in every single congressional district.
And this administration has talked about unifying the country and not Congress. Let's see how united the country is behind some of these policies, Lisa.
Yeah, we've gotten polls that signify that they are sort of more behind it than perhaps the Republicans seem to be signifying. The interesting thing is, even within the Democratic Party, there is so much disagreement. I mean, you think about what was not in this $1.8 trillion proposal, a SALT cap removal. How is President Biden going to make this plan appealing to the likes of Chuck Schumer, John?
Yep, it's going to be difficult, and we haven't even talked about Senator Manchin yet this morning either. Coming up, Will Power, Baird senior research analyst on a big 24 hours for earnings. news. Alphabet behind us, Microsoft too. Some of the numbers coming out of these tech companies continue to be absolutely amazing. After the close a little bit later, we will have Apple, then it's on to Amazon tomorrow. Ahead of all of that, the price action looks like this Wednesday. We have a Fed decision a little bit later too that we haven't even discussed in the first 25 minutes of this program. Equity futures up 4 points on the S&P 500, up about 1/10%. Yields higher by a couple of basis points, following up yesterday's sell-off with another nudge lower on a 10-year Treasury, yields higher to 164.31. In the FX market, euro negative by about 1/10%. Here we go. Euro dollar 120.74.
Surveillance correction. The Dow was 700 when my mother was lecturing me about it, not 300.
Thank you. Should have brought that ETF, Tom.
Yeah.
This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center.
To tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
From New York City for our audience worldwide, live on Bloomberg Television, this is Bloomberg Surveillance, and here's the price action. This Wednesday morning, equity futures up 4 points on the S&P, advancing about 0.1%. It is the least talked about equity market rally. Over the last month, we're up more than 5% on the S&P. We are totally desensitized by this rally now as we approach new all-time highs. Switch up the board and talk about the quietest 30% move I think I've ever seen. It came from Alphabet year to date, and hardly anybody's talking about it. Google is up by 30.72% year to date. I put 3M up there too. That's up a little more than 11%, and now I'm going to tell you why. We've been talking about reopening in America and the best way to get exposure and leverage to that theme. And I think the conversation almost exclusively around the traditional cyclical companies, the manufacturers, the industrials, names like 3M. Yet when 3M came out with earnings yesterday, where was the discussion? It was about costs, raw material, transportation. When Alphabet came out, where was the discussion? It was just about pure growth, leverage to a cyclical upturn and reopening. And Tom, that came from ad spend. And what didn't we hear? We didn't hear what we heard from 3M. Costs, transport, labor concerns, all of those things, they are not the concerns of the team at Alphabet.
And the Alphabet margins were really, really quite good as well. Love much more of that. Of course, analysis of Microsoft as well. Look forward to the close with the Romain Bostic this afternoon. Will Power joins now from Baird. Really been looking forward to this with his outperform on Apple. Will, I want to note the privatization of Apple. Since 2012, they've eliminated a very large percentage of their shares. They're down to 17 kajillion right now. Share buybacks are part of the fabric there. Do you just assume that continues in this boom economy?
Well, Tom, great to be here. Thanks again for having me. I think the short answer is yes. I think it has become a key piece of the fabric of the company. And the reality is it's become a good way to try to help reward shareholders with the prodigious cash, really, that they've continued to produce. And this is a company that we forecast to produce free cash flow approaching $80 billion. And despite spending a lot on R&D and other growth initiatives, they've continued to produce excess cash. And I think, as you know, they've had a policy to try to return that net cash position to neutral or effectively zero. And that suggests we're going to continue to see, aggressive buybacks. They've approached, call it, $30 billion a quarter. We expect that to continue going forward.
Are they going to announce a dividend increase today? I've seen that out in the zeitgeist. And if they do that, do they reaffirm their position by making it a near double-digit dividend increase?
That's a good question. It's not going to surprise me if we see a dividend increase. Whether it's double-digit or not, I don't know. But my suspicion is we'll see an additional, kind of doubling down, if you will, on commitment to both buyback and dividend increase. And I think it's likely we'll get that as part of the earnings release, but there's been no official announcement with that respect.
Will, what did you make of the announcement yesterday or earlier this week from Apple that they were going to invest $430 billion? I can't even say it, it's that much.
Traders, for the place to sell short euro, I'm looking to sell at 120.71. Okay. If you want to trade euro, here is your chance. 120.71 is the price I'm looking to sell. Okay? I'll speak to you later. Stay safe.
To ensure they have the production capabilities, the skill sets, and the R&D investment they need to continue to remain in a leadership position.
Well, and Tom accused me perhaps of being a little bit cynical yesterday because my immediate reaction was this is entirely a PR move ahead of different antitrust regulations potentially coming down the pike as well as higher taxes. And yet, how much